not uncommon prior to the first rate cut for markets to rally and make new all-time highs. However, to your point earlier about the sell the news kind of message here, rate cuts when they happen for a response to a declining macroeconomic situation, which it looks like, indeed, if it starts in September, that's what the Fed is going to be using as their rationale, have a very different equity outcome versus rate cuts that are accompanied with a soft landing. And so we'll have to wait and see which economic outcome we get, but it certainly kind of ratchets up the risk profile in the skew of outcomes if we've had so much of a run up into that first cut. And from my perspective, it's somewhat of a valuation-driven rebalance there.
When you mentioned fixed income, where on the curve do you think still provides the most value on a price appreciation basis?
Sure. I mean, this is kind of the more recent kind of area that we've changed our fixed income allocation. For the last 4 or 5 years, we've been underrate duration-wise. During 2023, we moved our duration back into kind of alignment with the Bloomberg Barclays Act, in between that 5 and 6 kind of year range. And most recently, a couple of months ago, we extended even further to an excess duration position in our fixed income portfolios with a very high credit rating of AA plus. In that position. We accomplished that just with a small position in TLT in our model portfolios, which moved our duration out a year or so. The thought there is that, as the Fed is starting to ease policy, as inflation is less of a headwind to fixed income pricing, this is a position that's a really nice diversifier in an environment like we're dealing with today.
All right, Matt, thanks so much for joining us. Really great getting your perspective, especially on a volatile day like today. So Matt Stuckey, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management, joining us on Zoom from Milwaukee, Wisconsin.
So on a day like this, Jess, as your senior team leader here for the equities market, how do you filter through the stories that you want to cover on a day where there's just so much thrown at you at once and
That's
so
right.
much is moving?
So we have a huge team. So we have about 30 different reporters specifically for the U.S. team. Then we have counterparts in Europe as well as Asia. And we have our team split up. So we have the micro side and then we have the macro side. Mm-hmm. So I'm the deputy and the senior editor, or senior reporter rather, for the macro side. So for me, I'm actually putting together our big weekend story this weekend that's going to look at, all things when it comes to the options market, what that's telling us technically, what that's telling us as well. Obviously volatility, so the VVIX, so that measures the volatility for the VIX. So that's also at its highest since last October. So that tells you that we could see a pickup in more volatility. And then also hedging demand, though.
Yeah.
So far, that's going to most likely potentially pick up, but it hasn't spiked just yet. So that's something, a corner of the market I'm keeping an eye on. I'll do more reporting on this afternoon.
I will definitely be reading those stories. Okay, coming up, we're going to talk about some of the movers in the market. Apple as well as Intel. Horrible day for Intel. Anurag Rana of Bloomberg Intelligence will be joining us right after the break. This is Bloomberg.
company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with your company news. This one for you, Jess. The stars at night are big and bright.
Deep in the heart of Texas.
Okay, we'll take
That's why you wouldn't let me sing it.
She's a Texas girl. Chevron relocating headquarters to Houston from California after repeatedly warning the Golden State's regulatory regime was making it a tough place to do business. The move announced this morning is going to end the company's more than 140 years of being based in the largest U.S. state. It comes amid a shakeup in senior leadership ranks, apparently aimed at improving results. Chevron already has slashed new investments in California refining, citing adversarial government policies in the state. Walt Disney's fabled film studio is roaring back to life, poised to report its first quarterly profit in over 2 years. Analysts surveyed by Bloomberg News forecast the division that includes theatrical movies is going to post a profit of about $78 million when Disney reports fiscal third quarter earnings come August 7th. The return to profit suggests CEO Bob Iger's efforts to revive the film division are starting to pay off. Deadpool and Wolverine, by the way, took in over $211 million in U.S. and Canadian ticket sales when it opened over the weekend. One passenger, this isn't really company news, sort of. One passenger suffered repeated panic attacks. Others held hands to try to comfort each other. Firefighters attended to at least 2 people. Business workers shed layer to layer after clothes drenched in sweat, all on a New Jersey transit train. It stayed unmoving, underground in a tunnel, no air conditioning, for 3 hours Wednesday evening. Passengers were told just about nothing, except if they got off the train, they'd be electrocuted or arrested. That sounds about right. That's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Friday. I'm Alex Steele alongside Jess Menton and John Tucker. This is Bloomberg Intelligence Radio. So the latest right now is that Citi adjusting its Fed rate call. They see a 50 basis point cut in September and November and 25 basis points in December. So things are moving fast and furious. What's also moving fast and furious is Intel stock. I just want to start there because it's whenever you have a company like Intel mention something like liquidity very high up on their earnings, that's never really a good sign. That stock is now plummeting 28%. I want to bring in Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. He can also hit on Apple as well. But Anurag, what happened here?
Yeah, I mean, Intel is going through a restructuring right now. So this is just a fallout from that because remember, right now, data center is where all the investments are going in, and NVIDIA GPUs is what everybody wants. So that's really not playing in the sweet spot of what Intel does. Big turnaround story, and it seems some issues there.
And as you know, that stock has already been under tremendous pressure this year alone, too. So usually when there's cost-cutting efforts, when you hear those kind of magic words, usually investors will gravitate toward that, especially when you think of, say, as you know, Anurag, Meta at the end of 2022 when it first announced its big tranche of job cuts and cost-cutting efforts. But with this, and especially the intricacies that you were just talking about, what exactly is it that investors need to see in order to have more conviction for a stock like this?
I think sales growth needs to pick up because at the end of the day, unless you see that, that's not going to translate into, cash flows and bottom lines. In the case of Meta, there was excess spending, but at the same time, their digital assets were still being used very aggressively by public, whether it's Instagram or WhatsApp. And there is no shortage of assets over there. So two different and distinct stories in the tech land.
What do you make of Apple then? It wasn't terrible at all. If we're taking a look just at the equity market, considering the sell-off that we're having, Apple stock is actually up 2.4%. So
best gainer today in the S&P 500.
Yeah, it was. You could say that tech is right. I mean, Apple is right now the cleanest story in tech land, only because they are not spending billions in capex. They are seeing some improvement on their top line, and with the promise of potentially a refresh cycle on the iPhone coming over the next 12 to 24 months. So things are looking good for Apple from on a relative basis when you look at companies like Amazon or Microsoft.
That's right, and especially because Apple, in the first quarter, it was worst performance relative to the S&P 500, one of its worst since the dot-com bubble burst. But if you look at where it was from mid-April to now, up almost 30% in that span. So even though there were concerns about China in this latest earnings report, still there's more optimism on the other side of that. So what improvements when it comes to China have you seen there?
Yeah, I think April is when the company came out and said that their numbers in China are not as bad as news agencies and analysts were making it out to be. And I think that led to a reversal of the stock at that point. And since then, they did a very big AI event, which surprisingly went very well because Apple's been criticized over the past few years of not innovating enough. So I think those two factors really changed the investor perception of Apple in terms of as a company and its fundamentals. And now we are waiting for the iPhone 16, presentation, which is going to be somewhere around the September timeframe. And with that will come the next level of, you could say, hardware refresh cycle. So things are looking good for Apple, not so much for the other tech players at this point.
Before we let you go, I mean, I understand you said that Apple's not spending boatloads in the same way on AI, but don't we want them to do that? Like at some point, are they going to be behind on that then?
So think about it this way. People are dying to have their large language model on the Apple distribution network. They don't have to spend the money. OpenAI can do all of that spending. They will just license it and to have it on their phone. This is another way for them to say, why do I need to make data centers when I can rent the data centers whenever I need them? So they have a fairly different strategy when it comes to capital allocation as compared to the other companies.
All right, Anurag, super appreciate it. Thanks a lot, Anurag Rana, Bloomberg Intelligence Senior U.S. Technology Analyst, joining us there. We have a lot coming up in the next hour as well, so stick with us. We're going to keep covering these markets for you, including what's moving. We're also going to talk to Bill Lees, Chief Economist at the Milken Institute, on these job numbers. As I mentioned, Citi now seeing 125 basis points of cuts for this year, a big change within the market, and you're looking at the S&P.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it, but this day ain't over yet. We are looking at the NASDAQ off by over 3%, the S&P off by 2.6%. I'm Alex Steele. Paul Sweeney's sunning himself on the beach. Jess Benton is pulling the duty. But I can't imagine someone who's better equipped to sit with me, because this is like what you do. You
That's right.
live and breathe
you live and breathe
all
this
day.
stuff. NASDAQ 100 about 11.5% off of that July high. S&P 500 off just over 6% from its all-time high right now.
Well, we're going to address all of this throughout the next hour. We're going to also talk to Bill Lees, Chief Economist at the Milken Institute. Obviously, the trigger today was the jobs data, but also tech has been triggering this as well. Let's not forget some short covering with the yen. Let's not leave that out over this week. Ben Emmons will also be joining us, Senior Portfolio Manager. He has his own shop right now, Fed Watch. We'll talk to him. Also, it's Munis in Focus, and it's Friday, so Eric Kazatsky, Bloomberg Intelligence Senior Municipal Bond Strategist, will be joining us. Plus, we can't forget the bond market. We're seeing a huge rally in that front end, so Ira Jersey, Bloomberg Intelligence, will also be joining us. But let's kick it off here, get you some broad strokes. Here's a business flash with Charlie Pellet.
All right,
Charlie?
thank you very much. Steep losses, Alex, for the U.S. stock market today. Equities tumbling, S&P poised for its worst day in reaction to jobs data in almost 2 years. Market drivers brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low, transparent commissions. Learn more at ibkr.com/bonds. Right to the numbers. Steep losses, worst level of the day right now. S&P just above 5,300, 5,307, down 138 points, down 2.6%. The Dow is plunging 888 points, down 2.2%. The Nasdaq Composite Index down 3.2%, dropping another 543 points. The Nasdaq 100 Index down 3.1%, while the Russell 2000 is down 4.2%. The catalyst for today, This morning's jobs report, also earnings last night from a number of tech companies, but that weak jobs report fueled worries that the Fed has been too slow to cut rates, risking a more pronounced economic slowdown. Neil Dudde is head of U.S. Economic Research at Renaissance Macro. He was the guest this morning on Bloomberg Surveillance.
The Fed has plenty of ammunition to kind of, course correct here. I think they'll use it. And, this isn't about household balance sheet deflation. This isn't about corporate balance sheet recessions like 01. This isn't about an asset bubble bursting. This is just about monetary policy being too tight.
Neil Dudde of RenMac, 10-year, 3.82%. The 2-year, 3.91%. Spot gold down $12 the ounce, down 0.5%. West Texas Intermediate crude now with a 73 handle this Friday, 73.56, down 3.6%. Briefly after earnings, Intel shares, they are having their largest decline in over 40 years. Intel plunging right now by 28%. Amazon after earnings down 10.6%. Apple after earnings up now by 2.1%. Got to keep it locked into Bloomberg Radio. Fast-moving markets, and yes, we've got you covered. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, appreciate that. Thank you very much. I am struck by Cameron Kreis. He writes Macro Man every day.
Yes.
So this is his conclusion at the end. He's like, for some reason, he's reminded today of Princess Leia and the urgent message to R2-D2, right, to Obi-Wan Kenobi. Help me, Obi-Wan Kenobi, you're my only hope. And he says, when the equity market's like this, who are they going to plead to? Is it going to be Powell? Is it going to be NVIDIA? And I thought that was actually quite clever.
I actually want to give a shout out to Elena Popina. She's our team leader over on equity. She also covers the options market very closely here. So she's talking about how the VIX curve is actually now inverted and it tends to jump around during the day. But if it stays this way, we'll need to keep a close eye on this because the last 4 inversions in the VIX curve have all coincided with a near-term low in the S&P 500 and has tended to be a reliable buying signal. To your point earlier when you talked about watching how we close and what happens at the beginning of next week. So that's something else that our equities team is keeping a close eye on.
Ooh, okay, interesting. I love that. All right, let's get more details on some of the individual movers. Natalia Knežević joins us, Bloomberg Equities reporter. Natalia, you're looking at Intel because it's just having a horrific day.
Exactly. That's the biggest drop on record. So we see that the company missed across the board sales, margin, EPS for both second quarter as well as expectations for the third quarter. Everything missed expectations. And the fact that the company is suspending dividend, and as management said, it will continue doing so unless they see cash flows improving to some sustainable levels. And on top of that, of course, it's cutting global workforce, plans to slash about 15,000 jobs, which is about 15% of global workforce. So that also sends a warning message that the company is kind of seeing has low confidence on sales. We also should take a look at company's credit profile because liquidity is still at a sustainable level, but weakening demand, lower cash flows, all of that led to the fact that 3 main credit rating agencies, they lowered the credit rating. And also analysts are saying, Bloomberg Intelligence, that there is a potential for further downgrades.
Yeah, unfortunately, the second worst performer here in the S&P 500 on a percent basis, Amazon. We were just talking about this earlier. AMZN is the ticker symbol, down a little over 10% here. And obviously those shares sliding when it comes to the AI spending plans and what that means. What are you seeing there when you're looking at that stock and when you're speaking with your sources?
Right. So on the one hand, cloud, computing performance was pretty strong, but we got another indication that people are getting more cautious in terms of how much they spend. I don't know how much you guys shop during the Prime Day.
She's totally directing that at me right now. She's known
I tend to have a lot of items in my cart too that I constantly save and kind of debate whether or not I'm one of those.
I was super prepped for this Prime Day, so I made a list. So yes, I was very organized.
You so well.
Wow, I love that. Yeah. I need to be more like y'all.
Yeah. So, but at the same time, yes, Amazon is saying that yes, people are getting more cautious, and many analysts, for example, JP Morgan, they are saying that there is no change in view that retail margins will continue to expand over time. But the management also blamed some external events, right? So they say Olympics or presidential debate, they distract shoppers. I don't know to what extent
It's called multicasting, girl. We
I
can
know.
do that.
So true.
All right, let's end up with DoorDash because that's up 7%, and this is impressive because you feel like if people aren't going to spend money or they're retrenching, you're not paying money for DoorDash. You're going to go out and get your own food and use your feet.
Exactly. So that's the bright spot, right? We see that that's the biggest day intraday gain in 9 months. So the company said that they added more merchants to marketplace, especially from areas like grocery or beauty. Alex, also something that we should keep in mind. So, but at the same time, the company did not provide a timeline when it expects to become operationally profitable. Some analysts are saying that this may happen at the fourth quarter of this year, but we will see. But at the same time, again, like mixed result, but total orders increased 19%. That's pretty impressive.
I'm not going to let them do my own skincare, please. So Natalia and I used to work together. We used to sit next to each other. And it was like
that.
skincare trading thing. It was a whole...
And then my team stole her.
And then you
she's
stole
on our
her.
team.
And do you guys talk skincare with her? Because
Actually, no.
I highly recommend this
We talk stocks.
conversation.
We talk stocks and hedging demand.
Okay, we talk about oil and skincare, not together, but two separate things. All right, Natalia, thanks a lot. Really appreciate it. Natalia Knežević joining us, a Bloomberg Equities reporter, on a very busy day. So let's get to the economic part of this. Bill Lee is chief economist at Milken Institute, and he is joining us now. Hey, Bill, the market is taking this jobs report as like a total disaster, like a complete growth scare. Is that the right way of looking at it?
I spent my entire career warning people not to overreact to one data point, and it looks like the markets are continuing to do that. Markets never disappoint in always overreacting. And right now, all I can say is that how can you have a recession when the unemployment rate is between 4 and 4.5, which most people think is where the natural rate is supposed to be? The second thing is that the numbers are showing that the unemployment rate has gone up because the labor force has grown more than the population. The layoffs are starting to mount up this month, but this is the first month of layoffs that we've seen. So for me, I think the recession calls and the fears in the markets are way overreaction.
And I'm glad you brought that up, Bill, because Alex and I earlier were talking about the latest Atlanta Fed GDP now number for the third quarter coming in at 2.5%. And as you know, those numbers can be volatile, but still when you're looking at kind of the trajectory here for economic growth, still looks pretty solid. When you're talking about the dynamics within the labor market, and particularly the participation rate, how much does that play into, especially when you see a number drop like that, as far as who's coming into the workforce and who's leaving it?
That's really critical, Jess, and I'm glad you brought that up because as much as people point to the SOM rule and the unemployment rate rising as being a recession indicator, a lot of indicators and historical relationships like that have just not worked so well. How long has the yield curve been inverted, for example? And people have said, "Oh my God, that's always a good indicator that we're in a recession."
Right.
So I think we have to look carefully at that composition of the labor force, and what we see is that immigration and other factors have people just wanting to work now because it's easier to get to work, and there are more jobs readily available. So people are encouraged to participate and try to get more jobs. Now, the bad part about this is that consumers have been spending like crazy, as we know, and savings rates have been dropping. Now, the rich people have been dipping into savings, but the median worker and the lower half of the population have really been resorting to a lot of credit in order to make ends meet. And part of that making ends meet is getting a second and third job, because most jobs that are available right now are in leisure, hospitality, and sectors in the economy where wages just aren't that high. Mm-hmm. So for me, the real problem out there is the growing bifurcation in the population of rich and poor. And I think we're going to start to see more and more of that as we go toward the election.
I mean, yeah, that K-shaped recovery or economy just keeps getting more K-shaped. Your old alma mater, Citigroup, came out with their call. It's 125 basis points for this year in terms of cuts, 50 in September, 50 in November, 25 for December. That feels like one of the more dovish calls out there. Do you think it's an economy that needs that kind of move?
Well, I'm glad we're not there anymore, because the need to attract client attention is something that I don't need to worry about anymore. And I feel sorry for Andrew Hollenhorst, who's still in the business of trying to distinguish himself from every other economist out there. I think that's a bit overboard. From my experience at the Fed, I think the reaction at the board and among all the district banks, they'll be saying, we're normalizing the economy. The need for large number of rate increases is really not there. And if we were to do it, it would signal to the markets that there's something to really worry about and that we're panicking. And the need to panic right now avoiding the impression of panicking right now is, I think, paramount for the Fed. So I think we're going to see 25 basis points in September. And maybe if the data continue to deteriorate like this, they'll talk about a more continued set of rate increases and probably hint at 3. But if the data starts to turn around a bit and stabilize and normalize, and we don't see an acceleration in the worsening, I think they're going to say, possibly 2.
Where do you see average job growth coming in over the next 12 months with the expectations that the Fed is going to begin its rate cutting cycle?
Yeah, I think when we look at where the payrolls are weakening, it's exactly in those sectors where the Fed wants it to weaken, the interest-sensitive sectors. In fact, one surprising part of the numbers is how strong construction continues to be. But I think the Fed is going to start saying, if we are successful in normalizing interest rates and normalizing the economy, we'll see payrolls and household employment grow somewhere in the 100,000 to 120,000 range. That's normal. And so everything we've seen up until now at the 200 level is way above normal and not sustainable.
Here's my broad question, also how it relates to tech. These hyperscalers are spending gazillions of dollars, that's a technical term, in terms of spending for AI. Can we have a meaningfully weaker economy with that kind of CapEx spend?
Great point. Because as we see in the numbers this month, one of the surprising sources of job decline, payroll decline, is in information systems. Now, fortunately, most of that, or almost half of that, is because of broadcasting and newspapers and publishing. But there is a component that talks about where the hyperscalers are. And that also shows a small set of job, the payroll declines. And I think what we're seeing is that companies are having to rationalize their finances and to say, if we're going to spend a lot on CapEx, that means that we're using capital, AI, and other types of innovations to substitute for labor. And especially labor that's very expensive labor. So right now, if you don't have the right skill set in the IT high-tech industry, your jobs are on the line because you're going to have to prove to the employer that you're going to be a value-added producer going forward in a world where AI threatens to take over a lot of the skilled jobs. Skilled jobs like, entry-level programmers, where software itself is being written by the AI software that's being installed.
So with Jackson Hole obviously coming up at the end of this month, so we'll have a lot of different Fed speakers between now and then in the next few weeks. I know Alex is excited about that. Obviously, that September 18th decision being the next meeting for the Federal Reserve will decide on rate cut expectations. But how many rate cuts are you really forecasting either for this year or over the next 12 months? Because like we've been talking about so much, Alex and I, the economy's still strong. I mean, it doesn't seem like this is going to necessarily need to be an aggressive rate cutting cycle like something you would have seen during the pandemic or the great financial crisis or coming out of the dot-com bubble bursting here with the economic growth still pretty sturdy here. So what are you foreseeing here?
That's a great question, because I think the real onus on Chair Powell now is at Jackson Hole to calm the markets and say, we're not in a recession, we're not panicking, we are in a normalizing situation. That has to be his primary message. And in doing so, he will try to hint more at the expect 2 cuts, possibly 3 for the rest of this year, and nowhere near the levels of 50 basis points initially, and we'll front load it with the equivalent of 2 cuts, and we'll have to continue with 2 more for the rest of the year. That would be the wrong message to send, because right now markets are way overexcited about the possibility of recession. I think his job in Jackson Hole will be to calm the markets and calm expectations and to restore a sense of historical perspective as to what is normal and what is a normal Fed reaction to what's going on, which is moderating interest rates because they are restrictive right now. There's no question, but we don't need to panic and cut them so aggressively.
All right, Bill, we appreciate it. It was great to talk to you again. It's been a while for me. Bill Lee, Chief Economist at Milken Institute. Really good to get that perspective. So sort of walking that tightrope then of having to work back some expectations now from more Fed cuts, but keep showing that the economy does need a little bit of support. That is another kind of tightrope balancing that the Fed's going to have to do over the next few weeks. Coming up, we're going to talk about munis because it's Friday.
That's
Eric
right.
Kazatsky, are you into munis?
I am. It's going to be a good conversation.
I love it when someone's into munis. Eric Kazatsky, Bloomberg Intelligence Senior Muni Bond Strategist, will be joining us. Taking a look at the markets, the Nasdaq is off by 3% on this weak jobs Friday and a really strong bond market. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 on track for its worst jobs day in 2 years. S&P right around 5,300 right now. It is down 2.6%. The S&P down 143 points. The Dow now lower by 957 points, a decline of 2.4%. The NASDAQ Composite Index is down 532 points for NASDAQ, a drop right now of 3.1%. The unemployment rate rose again, cementing a path to a Federal Reserve rate cut. We've got the 10-year now yielding 3.82% with a 2-year 3.90%. Gold down $23 the ounce. That is a drop of just about 1%. Big drop for West Texas Intermediate crude down 3.7%, $73.50 for a barrel of WTI. The violent rotation from big tech plunging is plunging the NASDAQ 100 index into correction territory. Bottom line here, steep losses for the U.S. stock market. Bill Lee is chief economist at the Milken Institute. He was interviewed moments ago here on Bloomberg Intelligence, and he told us this selling is overdone.
I spent my entire career warning people not to overreact to one data point, and it looks like the markets are continuing to do that. Markets never disappoint in always overreacting. And right now, all I can say is that how can you have a recession when the unemployment rate is between 4 and 4.5, which most people think is where the natural rate is supposed to be?
Bill Lee of the Milken Institute, interviewed right here on Bloomberg Intelligence. Again, the 10-year 3.81%, the 2-year 3.89%. Big tech certainly not helping matters today. In fact, we've got shares of Intel plunging 27%. As for Amazon after earnings, down 10.2%. Apple after earnings up just about 0.2%. Some of the other stories making news today, we have got Chevron relocating headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime is making it a tough place to do business. Recapping, S&P now down by 2.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
Today's Munis in Focus is brought to you by Build America Mutual. Insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM insured bonds. And to do so, we go to Eric Zatsky, Bloomberg Intelligence Senior Municipal Bond Strategist. Here's my really dumb muni question of the day. We have a massive rally in the bond market. We have a massive sell-off in the equity market. What does that wind up doing in the muni market?
Unfortunately, not a lot. And it's a great question, and it's one that's sort of been on top of mind for everyone in my space this morning. Like, why aren't munis rallying as hard as treasuries? And I think this goes back to just the fact that munis tend to underperform when we have sharp rallies in treasuries. For no other reason that it seems that we need a day or so of exact confirmation that this is a real move before munis tend to catch up. So let's say that this holds, we have rates rally throughout the day for treasuries. You would expect to see a similar movement as far as both direction and breadth, probably by midweek next week, especially as new issue starts to roll out.
And you had an interesting take for Bloomberg Intelligence for your research earlier this week, where you talked about how when it comes to sort of these midsummer approaches, usually in August, it potentially could be another month of positive performance when you're looking at tax exempts. Can you elaborate a little bit more of that when it comes to the seasonality and how that plays into some of this?
Yeah, absolutely. So look, each month we take a look at, both attribution for returns for the index from the month that we just had, and then take a look ahead and try and get out our crystal ball and take a guess, right? More often than times not, especially in the summertime, you could sort of read the tea leaves as far as demand and cash flows coming back to investors and get a good sense. What's interesting is that since the pandemic, what's usually happened in August, for the past 10 years prior to 2020, has not been happening in the last 4. We expect that actually to change this year just because of how much momentum there are in the rates market. And I think this latest jobs report is pretty much icing on the cake as far as really a big guidepost to breaking that ice cold spell of the last 3 or 4 Augusts in the muni market.
If we get a sell-off in the jobs market, a real weakness in the job market, right? Just, for the headline, we have JP Morgan now coming in, also doubling down here, saying there's a 50 basis point cut in September and November, then 25 bips at every meeting after that. They even see a strong case for an intra-meeting cut, a cut before September. In that environment, are munis a safe haven, or if the economy really contracts, do different regions desperately need more money? How does that play out on sort of a broad eco level?
Yeah. I think munis are really sort of the risk haven, right, play, for those who want uncorrelated risk. We have a lot of foreign investors who are interested in munis, especially taxable munis, because they want dollar-denominated risk assets, but something that's uncorrelated from the broader corporate markets. That holds true for tax exempts as well, right? If you look at historical correlations between tax exempt munis and, let's say, S&P 500, it's completely insignificant from a statistical standpoint, like a 0.19 correlation over that time period. So you're really sort of getting something that doesn't behave the same way if we head into a recessionary period, which is something that I think investors would want if there's a lot of proactive volatility in the equity markets.
When you're looking at munis, and especially breaking it down more toward a particular state level, which ones are leading the way for when it comes to maturities right now?
It's really going to be California, New York. Nothing is really that complicated in my market, and I don't want to sort of give away the secret that it's not that complicated of a market, but, I think people are very sort of, I think it's mired in mystery, and it really is quite simple, right? The biggest areas of population center have the biggest loads of debt, and they're the biggest issuers, right? Texas, California, New York, really sort of top of mind as far as big issuers in our space, both in exempt and the taxable market. So they're really going to lead as far as maturities coming up. What that also means is that they carry the heaviest debt load. So the last few years, they've had to issue at much higher interest rates, and their debt loads have looked pretty strenuous. The good thing is, as rates come down, we're hoping that that sort of flips the other way and is a positive tailwind for, better, sort of financial stories for those states.
All right, what are we looking for next week? Any cool issuance happening? Any sort of weird mall with like roller skating in it that needs some financing? I don't know. I really don't. That actually sounds cool.
Yeah. The only thing that we're sort of keeping an eye on is, the biggest deal that I think of interest to us is Tampa Airport. They're issuing about $500 million. But what's super interesting is, I think the recovery story when it comes to air travel is really underappreciated. And if you look at sort of employment growth for the Tampa Airport area, they've blown past pre-pandemic levels, which really goes to show you that they've had a lot of embedded population growth in that area, but also leisure and business travel is back, especially in the Southern Florida market. Now, obviously, we're coming up in a period where we're going to have, typical hurricane season. We don't think that's going to be much of an issue as far as travel goes, but it's really sort of a reassuring sign to see so much growth there. And they're a credit that has over 700 days cash on hand, so really a good credit story to get behind.
All right, Eric, thanks a lot. We appreciate you. Thank you very much. Eric Kazatsky, Bloomberg Intelligence, who covers munis for us. Let's get to some other earnings, because it wasn't just tech and it's not just about eco.
Energy, which you follow very closely.
This is big oil's day. You got Exxon and Chevron. They always wind up reporting on the same day. And it's a tough road right now for Chevron. That stock is down by about 3%. They do have strong U.S. Permian growth. They made 2 acquisitions, and that continues to be strong for them. At heart is this issue over Guyana. It's offshore. It's an amazing asset. Hess owns 30% of it. Exxon and CNOOC own the rest. Chevron tries to buy Hess for other stuff, but also in part for Guyana. It's a $53 billion deal. It's huge. Now Exxon, who's never made a bid for Hess, comes in and say, hey, you can't do that because we have right of first refusal because they're in a project with us. Usually that applies on a project-for-project basis, but not on a whole company takeover basis. And that arbitration is stinging Chevron right now and pushing out that deal potential now till May of 2025. I sat down with CEO Mike Wirth, and I talked to him about how he navigates citing production strength within within Chevron, but also saying how much they love Guyana and want the Hess assets.
We had some higher maintenance. We had a couple of events at LNG facilities that required maintenance during the quarter, which brought liftings down. And so it's a little bit hard, I think, for analysts to anticipate that. We tried to communicate those events, but we had that. Refining margins came off hard in some of our key markets. And then there were some one-time items, well write-offs and tax items that are very difficult to forecast. So these are non-recurring items that made the quarter a little bit light versus expectations, but the underlying execution is good. And as I said, the growth remains strong.
So now you have to wait till May 2025 for the arbitration to work out when it comes to that Hess deal. Why is this taking so long? Like, if it's a simple issue or it's an issue of scheduling, what's the problem?
Well, international arbitration often is a lengthy process. Selecting the arbitrators, getting schedules aligned between all the parties and the arbitrators is more complex sometimes than one might expect. we do continue to see this as a straightforward contract interpretation question, and we continue to remain confident that the arbitration will affirm Hess and Chevron's interpretation of it. But you're correct; it is taking more time than we had originally anticipated, and that's unfortunately not unusual when you get into international arbitration.
Moving to some of the intricacies of the quarter, you mentioned it, that record production for Chevron in the Permian, which kind of leads me to you guys moving your headquarters to Texas. Is part of that needing to be closer to sort of the core business of operations right now?
Well, it's really to be closer to the core, epicenter of our industry. Houston is the energy capital of the world. We have key partners that are there, suppliers, vendors, the universities that we do a lot of research with and recruiting from are there. And so it's a natural place for companies in our industry to have their home office and headquarters. And in fact, over the last many years, we've seen our Houston-based employee population go up and our California-based employee population come down. And this is really concluding a process that has been underway. We know how to work around the world in kind of a virtual environment, but there's no substitute for being face-to-face with people in terms of collaboration, innovation, mentoring and development, external relations and engagement. And Houston really is the place for our company to be for all of those reasons. We do have a big business footprint in Texas, which is now larger than our business footprint in California. For many, many years, that was not the case. California was our home, it was our birthplace, and it was where our largest business footprint is. And so that's certainly a change that has occurred, but the primary motivator here is to get our people together to increase engagement and collaboration.
So pro-Texas versus anti-California?
I wouldn't necessarily put it that way. I would, look, we've had some policy differences with California, and certainly California and Texas approach energy very differently. And so we speak up on that. We advocate for policies that keep prices low, that keep supply reliable, that encourage investment. And California's advanced policies that do the opposite. And so we've certainly expressed our views that we don't think that's good for the California economy. But this isn't a move about politics. It's a move about what's good for our company to compete and perform.
That was Mike Wirth, CEO of Chevron, talking to me earlier about the quarter, moving headquarters, and lots of other stuff there. The call is going on right now, Jess. Chevron saying that they do have strong performing wells in the western part of the Permian. They're like, you guys, the time has passed on the Exxon block talks with them.
That's right, CVX, the ticker symbol on this, down about 3%, on pace for its worst day since yesterday when it declined almost 5%.
Yeah, that's when the news broke about that arbitration getting pushed out. All right, we're going to go broader markets. Ben Emmons joins us next.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. J.P. Morgan now joining Citigroup in predicting half-point Fed rate cuts in September and November as Wall Street banks see a bolder Fed response to weak jobs data. We've got more on the Fed, more on the markets coming up with Ben Amons of FedWatch Advisors in just a moment right here on Bloomberg Intelligence. Steep losses, off-session lows, right to the numbers here with the S&P 500 index now down 120 points, a drop of 2.2%. The Dow is down 913 points for the Dow, a decline right now of 2.2%. The Nasdaq Composite Index is down 413 points for Nasdaq, a drop of 2.4%. The Nasdaq 100 Index also down 2.4%, and the Russell 2000 Index of small cap shares dropping now by 4%. The 10-year 3.82% with a 2-year yielding 3.89%. Spot gold down $22 the ounce to $24.23, a drop right now of 0.9%. And West Texas Intermediate crude oil down 3.8%, $73.44 for a barrel of WTI. The jobs report is out. The unemployment rate is up. And with that story, here's Bloomberg's Vinny Del Giudice.
July's 4.3% jobless rate is the highest in almost 3 years, paving the way for the Federal Reserve to cut interest rates to cushion America's economy. The central bank could act as soon as its September policy meeting. Fed Chair Jerome Powell hinted this week. Interest rates aimed at stopping runaway inflation are at a 2-decade high and weighing on businesses. Recent data point to an abrupt pivot. Today's Labor Department report also shows U.S. payroll growth slowed in July. Vinny Del Giudice, Bloomberg Radio.
After earnings, Intel is plunging 25.7%. After earnings, Amazon down 9.1%. After earnings, Apple up 1.7%. Again, recapping, the Dow is down 913 points, down 2.3%. The S&P down 2.2%. The 10-year 3.81%, and the 2-year 3.88%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. I'm Alex Steele alongside Jess Menton. Paul Sweeney is sending himself today. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics. And we are live from our Interactive Broker Studio right here in Midtown Manhattan. Also, check us out on YouTube. All right, you just heard a market check there. It is ugly out there. I go back to Cameron Kreitz, macro man. He writes for Bloomberg that says, who's going to save the market? Help me, Obi-Wan. You're my only hope. Who's the only hope? Is it going to be NVIDIA? Is it going to be Powell? Is it something else? Ben Emmons is Chief Investment Officer and founder at FedWatch Advisors. He joins us now. Ben, what saves the market?
Yeah, it would be the Fed, if I say FedWatch Advisors, because, this is clearly a loud call for 50 basis points cut right now, right, because of this weak payroll data. Then again, the drill in the report, it's a lot about technology jobs. I guess that's what Powell really said. It's like the lags are showing up in the economy, right? The variable lags of policy, and technology gets hit by that the most. And guess what? That's also down the most today in the market. So I think, Alex, it's a 50 basis point cut that the Fed would have to deliver. Of course, it's not going to do it, but I do think that this report sets us up for the September meeting now for sure, as Powell sort of signaled it. So markets will eventually rebound from this. It looks like to me they were obviously overshooting to the downside, both yields and stocks.
And especially coming off the back, as you know, Ben, from Powell signaling that those rate cuts are coming as soon as September here. I mean, how much of this really changed from the last 48 hours? Because obviously we did get that manufacturing data yesterday. Of course, we had the jobs data this morning, but we already saw this decline really ramping up yesterday after a huge bounce and a huge rally with the NASDAQ up around 3% on Wednesday. And obviously the S&P 500 posting its best Fed day in about 2 years here. So how much of this is kind of like a re-rotation here, moving into other corners of the market when you had speculative areas like small caps really get ahead of themselves, especially in July, and now moving maybe toward these kind of dividend-paying corners of the market here?
Yeah, I think you're totally right, Jess. There's a really nice rotation function on the Bloomberg terminal that shows exactly that. You see precisely that rotation playing out the sectors that you described. So it is also about that. People look at this like, there's an election playing out here too. Harris catching up really quick to Trump in the polls, raising a lot of money. So the Trump trade is fading, and that Trump trade was very associated with small caps. against a backdrop of an economy that's just softening. I don't think this is the 2007 suddenly we're in a recession moment, right? Was back then the idea. But I do think the yield curve steepening indicates that, yeah, the economy is on a much slower path and you're getting lower payrolls. And, you know, small caps don't do that great initially on that type of news. So it's a combination of two. But I think that rotation will continue. That's why I think the sell-off in tech stocks is probably getting, you know, overshot to the downside, makes these stocks oversold. And that's why I think you can expect a rebound coming in once things settle out.
When you mentioned this is a clear call for the Fed to cut, like right now, and we've gotten calls for 50 basis points now from Citi, JP Morgan, you also mentioned that. I guess my dumb question here is why? I mean, I understand that the report wasn't great. There's obviously, you can look at some potential seasonality, like the permanently unemployed people. A lot of them are temporary unemployed in terms of the overall number. You could also make an argument that there is a weather factor, even though I understand some of the headlines showed no. But why the urgency?
Yeah, that's the puzzle a bit, Alex. Like, you know, why that sentiment shift suddenly? I think that people are looking at maybe the accumulation of data, right? So claims are steadily rising. The 4-week average is steadily rising. We're closer to that Sambro trigger, not exactly. You know, Mike McKee had a nice spreadsheet this morning on the show, and he says like you're just a tenth or whatever % away from that trigger. But I think that is the psychology ultimately. Even if Powell says that rule is just a statistical measure, nothing else. So it's psychology here that plays a role, and you know, ultimately it's about like the Fed can cut rates and it could remove more of the restriction. And if you drill in the report, as you say, there's definitely reasons why you don't have to cut with like slashing rates, because let's face it, we also have strong job gains in healthcare and construction and financial activity, you know, and leisure, which have been engines of growth in the economy the last several years. So that's not where the weakness is. It was really the technology jobs in itself. So I think it's more about psychology that we're Fed, you're behind the curve, you got to move. Why people are trading the 50 basis point cut, which, as we know, is unlikely to be delivered in September, more like 25. So it's more like the Fed now gets enough evidence to remove the restriction of this policy, and this report just cements that goal for that.
And to Alex's point, JP Morgan, Citi, seeing basically these Fed dealing 2 half-point rate cuts, but then also you have Goldman Sachs over there. They added a 3rd quarter point rate cut in November to their prior forecast. Also, Bank of America, who had been holding out for rate cuts in the beginning of December, they said they now see to look for the first move in actually September here. So when you're looking ahead over the next couple of weeks for other indicators when it comes to the economy, next week's a little bit lighter on the economic calendar, but we still have some services-related data coming out as well. But then the week after that, obviously, we'll have another update when it comes to CPI on August 14th. So what are you looking ahead between now and then? Because next week's also a huge earnings week, still on the back of coming out of these big tech earnings, because you have a lot of consumer-focused names that are going to be reporting.
Yeah, I would look at those, because that's where I think the issue is currently, right? If you look at the current sell-off today in the S&P, what's the worst performing sectors? The consumer discretionary, right? So I think that's where the economic pain point is currently today in the markets. So these earnings from these consumer companies are obviously key to watch for any kind of significant demand slowdown. You know, McDonald's was, I think, a kind of a wake-up call earlier this week of that it showed like, you know what, these consumers aren't so out there, you know, eating left and right everything, and are more conservative or getting more conservative. So that, I think that was the first precursor of what the consumer sector is really showing. That is the slowdown that we've been anticipating against the sentiment that you once again highlight. It's amazing, right? All of a sudden we're getting a weak report and every bank jumps all over one another to add more rate cuts. Well, at first they were reluctant to put out rate cuts, right? So I think it's that combination of that bit of the, you know, exaggerated sentiment that we know over all these years of analyzing markets that always happens after a payroll report, against the true economic environment, which is slowing. But I don't think this is the recession moment. But we definitely have to acknowledge that the Fed is probably over-tightening here, therefore they can change.
All right, Ben, we got to leave it there. Thanks a lot. Ben Emmons joining us there from FedWatch Advisors. He's the founder and CEO of that. Coming up, we're going to get the bond market reaction now. You got the 2-year down 27 basis points. We're going to get Ira Jersey's take on this bull steepening, and just what do you do in this environment? Do we need a 50 basis point cut, or are we just totally over-exaggerating the jobs data? We're going to break all of that down for you on the other side of this break. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Chevron is relocating its headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime is making it a tough place to do business. Chevron Chairman and CEO Mike Wirth spoke this morning with our Alex Steele.
Look, we've had some policy differences with California, and certainly California and Texas approach energy very differently. And so we speak up on that. We advocate for policies that keep prices low, that keep supply reliable, that encourage investment. And California's advanced policies that do the opposite. And so we've certainly expressed our views that we don't think that's good for the California economy. But this isn't a move about politics. It's a move about what's good for our company to compete and perform.
Chevron CEO Mike Wirth, again speaking with our Alex Steele. The move comes amid a shakeup in senior leadership ranks, apparently aimed at improving results. We got Chevron down today by 3.3%. That, along with the price of oil and a broader market sell-off. S&P, by the way, now down by 2.1%. Crude oil trading lower as well today. West Texas Intermediate down by 3.5%. ExxonMobil exceeded profit expectations after the $63 billion acquisition of Pioneer Natural Resources pushed oil and natural gas output to a record. ExxonMobil shares today, they are trading little changed. We've got ExxonMobil just about flat on the day. Intel suffered its largest decline ever after the company gave a grim growth forecast and laid out plans to slash 15,000 jobs. Intel is plunging right now by 26.1%. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Friday. We made it almost, but this is a crazy day. I'm Alex Steele, I just mentioned. Paul Sweeney took a very smart day off today.
That's right. Hope he's enjoying the beach.
Oh, he is.
While we're here doing the hard work.
Waves, for sure. All right, let's get to the bond market here. You got the 2-year yield off by 25 basis points. Want to get right to Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, standing by. Hey, Ira, Citi, JP Morgan, they now see 50 basis point cuts September and November. I mean, seriously, is this what we're in for?
I don't think so, but at the same time, like, it's not out of the question, and the market's now fully priced for it. So I guess the question is, if you believe that, then there's not very much you can do. If you don't believe it, then there's some trades that you could do in order to mitigate the fact that we're going to be trading, potentially trading for right now. 141 basis points of cuts, Alex, by the January meeting. So that's so that's a pretty significant number of cuts, and that's the reason why you have the front end rallying as much as you do, and you have and this is all things that we thought would happen over the quarter, a matter of 6 months, not in one day. So it's kind of directionally we got this call right, but certainly the magnitude of the move is somewhat surprising.
So when you're looking at, obviously, those rate cut expectations, because as you know, if you use WIRP in the terminal, depending on day to day, it can obviously be all over the place as far as what it tells us and which data points or earnings or whatever related to that can come out, and obviously Fed speak too. But when you're seeing something as volatile as this, and especially as you know, when you're thinking about, you're covering more of the fixed income side, but especially seasonally, this is more of a weaker time period the next 2 months for the equity market, but especially ahead of the end of the month when we'll have Jackson Hole and a lot of Fed speakers in between now and then. What are you expecting to hear? Because actually Austin Goolsbee from the Fed will be speaking on Bloomberg Television in just a couple minutes at noon. So what kind of rhetoric? Because obviously he's somebody who's been a little bit more dovish side of here.
Yeah, so obviously, doves are going to be doves, and people who are somewhat skeptical of the data are going to point to the fact that, yes, the data was weaker than expected and we're trending that way, but you still had job growth, you still have relatively low unemployment rates, certainly not near recession levels, but you could get there very quickly, right? And that's where, what I think people are worried about is, just the trajectory of the unemployment rate and the employment situation in general. For me, it was looking at some of the wage data, for example, that that was a little bit weaker than anticipated, because really consumer spending has to be maintained in order to avoid a recession or at least a meaningfully deeper slowdown. And if wage growth it continues to decline as it has the last month, then you risk having much slower spending. And so everything is kind of playing out more or less, I think, than a lot of people did. I think the market is a little on edge. It is also, like you said, look, Paul Sweeney's not even in the office, so how good can liquidity be, right?
Okay, well, this was my question.
Really bad.
This was totally my question. We only have about a minute left, but what is positioning? Like, how much of this is positioning squeeze, liquidity, stops triggered?
Right.
Yeah, I think all of the above. I'm sure a lot of people had stops just below, like between 403 and probably 398 on 10-year Treasury yields. You had a lot of people in that range who were short with stops and wound up covering shorts. You look at futures positioning, and it was still pretty massive. Dealers were completely full on their balance sheet. In fact, as of Wednesday, they had the largest Treasury positions that they've ever had. So that implies that investors were not particularly long. Right. So I think people don't want to miss the boat. Right. There's some FOMO going on here where if the Fed is going to cut rates, even if it's not as quickly as, Citi and some of those other banks suggest, rates are still going to go lower. So you want to get in front of that, and you want to be long fixed income when the Fed's cutting rates. And we've had a little bit of that in anticipation. But now that it seems like it's almost inevitable, you got to get in or you're going to miss it.
Yeah. I mean, to your point, you just didn't think it was going to happen all in one day. Okay, Ira, thanks a lot. We appreciate it. Know you're busy. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joining us. Jess, thank you so much for the help today with the assist.
So much fun.
I hope you got some good fodder for all your stories
get ready.
And your team.
9 a.m. Sunday when the story runs, guys.
Oh, yeah. And now she's literally going to be running back to her desk. All right, that wraps it up for me and Jess. Coming up, Balance of Power with Joe Matthew. Happy Friday. Good luck trading. This is Bloomberg.
Politics to the world of business. This is Balance of Power. Live from Washington, D.C.
The job market slows more than expected and markets tumble. Welcome to the fastest show in politics as we consider the implications of a hard landing in the middle of a presidential campaign season. A series of important conversations coming up this hour, including one with Austin Goolsbee, president of the Federal Reserve Bank of Chicago. We'll get details on the jobs report ahead from Molly Smith, and our signature panel is with us. We'll get political with Rick Davis and Jeannie Shanzano, all after a look at Wall Street. Let's get started on a tough day right now with Charlie Pellet in New York. What do you have, Joe?
What I have is we're off session lows, but still steep losses. In fact, we are on track for the worst jobs day in 2 years, Joe Matthew. Right to the numbers here. S&P down 110, drop now of 2%. The Dow also down 2%, down 839 points. We've got NASDAQ down 387, a drop there of 2.3%. Your 10-year, 3.82%, with a 2-year, 3.91%. That is a Bloomberg Business Flash.
Right, Charlie Pellet with his eyes on the markets. He'll be back later after a conversation with Austin Goolsbee. As I mentioned, we turn things over to Bloomberg's Michael McKee and Shonali Basic, now live on Bloomberg Radio.
Television and radio, I am Shonali Basic. Joining us now is Bloomberg's Michael McKee and Chicago Fed President Austin Goolsbee. Mike, get us started.
Thank you, Shonali, and thank you to everybody who is watching us around the world, including Austin Goolsbee joining us from Chicago. Thank you very much, Mr. President. Hiring dropped precipitously. The unemployment rate shoots up more than anticipated. Everyone wants to know, did the Fed make a mistake by not cutting rates on Wednesday?
Well, look, I'm not going to get myself in trouble and talk about what people's thinking are from the meeting. You're going to have to wait for the transcript to come out to see what was on people's mind. I've been saying to you, Mike, for a long time and publicly that we'd never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, that the market said maybe there would be 7 cuts for the year. And then when a month would come in, Then that 7 would drop to 3. Then there was a group saying maybe there will be an increase in rates. The job of the central bank is to figure out the through line and to move in a steady way. I've been warning that we are tight, we are restrictive. The real Fed funds rate is as high as it's been in decades, and as inflation falls, that gets tighter. If we stay restrictive for too long, we're going to have to think about the employment side of the mandate. And if you look here, if you take this summary, the statement of economic projections in the SEP, the neutral rate of inflation, the long-term rate of inflation and unemployment, say that people think full employment is about 4.1%. So if unemployment is going to go up higher than the neutral rate, that is exactly the kind of pinching on the other side of the mandate that the law says the Fed has to think about and respond to.
Well, you've been talking about a rate cut, yet you voted to keep rates unchanged. Why did you do that? And now do you think maybe you are behind the curve?
Well, look, like I say, I'm not going to get into talking about the secret discussion. You got to wait for the minutes and the transcript to come out. I was a seat filler at the Oscars. That's really Cleveland's seat. I was there for one meeting. The committee acts on the through line of the data, and the through line of the data, you should not change what you think the through line is based on 1 month's number. But in the overall, you know that I believe that we are restrictive. I think that I've been saying for months that what we wanted to see was improvement on inflation and especially improvement in the components like housing and services. And we've been seeing that. And that the longer we were restrictive, we're going to have to start thinking about the employment side of the mandate.
Well, you've heard what the banks, economists, and traders are saying today. Should the next move in September be a 50 basis point cut? And what do you think about JP Morgan proposing from a risk management perspective, there's a strong case to act before September 18th?
Look, Paul Volcker, my old mentor and friend, used to always, our job is to act and their job is to react. And let's not get the order mixed up on that. I fully understand why markets want to jump. If they get one scrap of information or they see one thing, they want to conclude a trend out of one data point. And I would just caution us, if we had acted at the end of 2023 based on a couple of observations, then these same people would have said, but look, inflation went back up in the first quarter, so that was a mistake. I think the most important thing is to look at the through line. What will determine the action is we don't want to tie our hands now. We're going to get a lot of information between now and the next meeting. And what will determine the size or if there is action at all will be the conditions. And that's the way it should be. That's, as I always say, the data dogs, there's a time for walking, there's a time for sniffing. The sniffing time is when there's a lot of uncertainty and you don't know what's what. Once you get the through line, that's the time for walking.
What exactly would it take to see a cut before that September meeting?
I'm not going to get in a speculative bit about that. The FOMC acts in a consensus manner. We have deliberation and debate, and we vote on things. And I try to bring the through line mentality of you don't take 1 month's number, look at what the trends are. And to me, the trends show inflation coming down across the board, multiple months in a row. They show the labor market cooling. What we want is for the labor market to get into good balance, sort of the full employment natural rate. If we're not stopping at that, and we're not neutral, and we're gonna have to be thinking about the employment side of the mandate.
It's not just about the next cut. It's also about the path forward from here. For the people that think that you might get multiple, even multiple half-point rate cuts through September, through November, through December, what do you tell them in terms of what to expect for the entirety of the path going into next year?
Look, you know I don't like tying our hands even for the next meeting, so I certainly don't want to commit ourselves to what's going to be the rate path 5-7 meetings from now. With all of that said, just look at the statement of economic projections, and you can see that as a committee of the individuals have believed that the conditions will be appropriate to have multiple rate cuts with the unemployment getting into better balance and with inflation coming down to target, but even at a run rate that's a little higher than what we've seen in the last couple of months. So it's not any secret. The Fed's been pretty vocal about here's what the reaction function is, and expecting, as is historically true, when conditions warrant a cut, they tend not to be one individual cut. The SEP shows that the median dot of the dot plot has multiple cuts over the next year.
How weak is the U.S. economy overall? I want to point out something that your governor, J.B. Pritzker, the governor of Illinois, said just 2 days ago. Interest rates are holding companies back from making the investments that are necessary. All these companies are companies that are on a generally upward trajectory over the last decade, but are having a hard time in the moment because of some of the challenges the Federal Reserve has brought.
I mean, in a way, that's a description of monetary policy. That sounds like he's saying policy is restrictive, and I agree with him. When the real federal funds rate, that is the Fed funds rate minus inflation, that's as high as it's been in a very long time. That's the highest it's been over this cycle as inflation comes down. We set that rate a year ago at a time when conditions were very different than they are now. And you should be tightening by choice, not by accident. You shouldn't back yourself into tightening. What we need to do is take the through line on inflation and unemployment, and that's what should determine our policy. I don't want to argue about the words, how good or how weak is the economy. The numbers are the numbers. We've seen GDP growing around trend. We had one weaker than expected GDP growth number at the beginning of the year. Then we had a stronger than expected in the second quarter. And so we're growing, but it's slowing down. The strongest thing in the economy has been the job market. The weakest thing in the economy has been the inflation. Both of those are converging back to, let's call it normal or what it was pre-pandemic. And our absolute goal now is we want to settle at something like full employment, not blow through normal and deteriorate.
Well, I think the major thing that people want to know going forward is, now you mentioned all the data coming up. What are you going to be looking at? What are you going to base your interest rate decisions on?
I mean, for the dual mandate comes to us by law. The law says the primary things we got to look at are inflation and the job market, and are we maximizing employment? So those are going to be the big two kahunas as we go forward. But it is still an economy with cross currents, where you got some things that remain quite strong by historical terms, and other things that have deteriorated. So if you look at credit card delinquencies or small business defaults, those have been rising, and they have moved into what I call warning sign stage. So I'm going to be looking at what Chair Powell calls the totality of the data, not just the monthly PCE inflation and jobs reports, but the PCE inflation and the jobs reports are the big two for sure by law.
We do have to leave it there. Wish we had more time, of course. That is Bloomberg's Michael McKee and Chicago Fed President Austin Goolsbee, off the heels of a very highly watched and surprising jobs report. We thank you both very much for your time.
All right, big thanks to our colleagues Shonali Bossack and Michael McKee for a fascinating conversation here on Bloomberg Radio with Austin Goolsbee. Again, you're hearing it straight from the president of the Fed Reserve Bank of Chicago. I'm Joe Matthew in Washington, of course, where the jobs report came out this morning and shocked a lot of people. That's why we're talking about this. That's why the market is in the shape that it's in. And it's why we need to talk to Molly Smith, Bloomberg economics editor, watching the data as it hits the tape at 8:30 and presenting our coverage here on the terminal and online. It's always a pleasure to pick Molly Smith's brain on a jobs day. It's great to have you back, Molly. We missed you, and this is an important one here. Unemployment up again, as I read in the headline, cementing the path to a Fed rate cut. You've got people talking about an intermeeting cut like Alan Greenspan is back. Just give us the 30,000-foot view. Things have turned on a dime here, haven't they?
Yeah, this really is challenging a lot of what Powell and a lot of what people assumed was a gradually cooling labor market. That's what every other data point pretty much has indicated to us up until this point. But the jobs report today really made us think that perhaps things are deteriorating much more quickly than we had assumed, and is also now raising a lot of concerns that a recession indicator has been triggered and that there's a more serious downturn perhaps ahead. No one thinks that we're in a recession right now, that's clearly not the way that the data is signaling at large, but there is a lot more chatter now, of course, that perhaps the Fed should have acted this week and that September may be too far away, but I think a lot of people at the Fed would certainly push back on that, and they are probably for sure now, of course, looking to cut rates in September.
Okay, I'm glad that you said that because I think you're referring to the Somme rule there, and a lot of folks have been saying, look, we could already be in a recession, if not heading straight into one this summer, and it might not be a long or deep recession, but is there not a chance, Molly, we look back at this time now and find out we, in fact, were in a downturn?
I mean, there's certainly a chance. You know, it does all really start with the labor market. Once people are, more of them are out of work and not receiving income, that's when consumer spending tumbles, and the rest of the economy could certainly go with it. But right now, we don't have an indication that that's happening, that consumer spending is still fairly holding up fairly well, that other parts of the economy have certainly been weaker, but not falling off a cliff. You could look at the GDP report that we recently got. That would be a good indication that, you know, that the economy is still holding up pretty well. But yes, the Somme rule basically is a measure that points to how quickly the unemployment rate rises within a certain period, and that was triggered with the jobs report today.
Well, you can't deny the headlines in the jobs report, whether you're looking at the payroll side or the unemployment rate. Molly, what got your attention this morning? What are you worried about?
Yeah, certainly the unemployment rate is the big one, and that seems to be more what markets are reacting to. I mean, of course, the payroll growth certainly was a lot slower, but this is where you also have to take into account that Hurricane Beryl certainly could have played a role in some of the numbers today in terms of the payrolls number being weaker than expected, in terms of hours worked being lower, in terms of wage growth slowing. Also, so many people reporting that they weren't able to work because of weather or only working part-time when they normally would have worked full-time due to the weather. Interestingly, though, the BLS said that Hurricane Beryl had, quote, no discernible effect on the numbers. So would love to know why they characterize that as such when it seems to be saying otherwise.
Really interesting here as we spend time with the very editor that touches up the stories you read here on the jobs report, talking about the Somme rule. We're talking about the potential of an intermeeting cut. This is not the tone of the conversation that we were having even just a couple of weeks ago. What are the chances, Molly, you know, if we're casting about here on a Friday afternoon, that we see a cut before the meeting in September?
I think you would have to see a lot more data point to more rapid signs of deteriorating in the economy. Keep in mind, the Fed's September meeting is still 6 weeks from now. That's a lot of time to see more data come in and perhaps tilt them toward that way. But I wouldn't think based on today alone that we would see a cut before September. And I think a lot of Fed officials, too, would push back on the idea of even as of today, again, going for a larger 50 basis point cut in September, just because those moves tend to really ignite panic and maybe signal that there's an emergency, which is the last thing that they would want to do right now.
Producer James goes dumb and dumber with, so you're saying there's a chance, Molly Smith. We only have a minute left. What's the next most important stop on the road here when it comes to data?
I mean, it's pretty clear right now that the mandate is, that the focus right now is on the employment side of the Fed's mandate. So really anything that's looking at further deterioration of the job market is just of paramount concern right now.
All right. I don't feel better, by the way. I usually feel more positive about things when I talk to Molly Smith. This is real. No, don't be sorry. She reports the news on a Friday, Molly. It's great to see you. Bloomberg Economics editor Molly Smith getting us rolling here after a fascinating conversation with Austin Goolsbee. Where else are you going to get this alongside your lunch but on Bloomberg Radio? We'll have a lot more ahead as we keep politics in mind here, too, on Balance of Power. Stay with us. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Steep losses for the U.S. equity market. J.P. Morgan Chase joining Citigroup now in predicting half-point Fed rate cuts in September and November as Wall Street banks see a bolder Fed response to weak jobs data. Austin Goolsbee is the president of the Federal Reserve Bank of Chicago. Moments ago, right here on Bloomberg, he told our Michael McKee he understands the urge to act, but says you got to be patient.
The committee acts on the through line of the data, and the through line of the data, you should not change what you think the through line is based on 1 month's number.
10-year yield, 3.83%. The 2-year right now, 3.93%. Stocks off session lows, but still a lot of red on the screen on this Jobs Friday. S&P down 104 now, a decline of 1.9%. The Dow is down 753, down 1.9%. NASDAQ down 379, a drop there of 2.2%. Again, the 10-year, 3.83%. Spot gold down $13 the ounce, down 0.9%, 24.33 the ounce. And West Texas Intermediate crude tumbling now by 3.4%, 73.74 for a barrel of WTI. Speaking of the oil industry, Chevron relocating headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime is making it a tough place to do business. Chevron shares down by 3%. After earnings, ExxonMobil now down by 0.6%. Recapping stocks lower, S&P down 106, a decline of 2%. Balance of power continues now. Back we go to Washington. And once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, we're taking quite a bumpy ride with Charlie today, but he's got tabs on the markets, and we're going to keep you filled in on what's happening for stocks and bonds on this jobs day that kind of blew everything out of the water. Expectations about the future trajectory of our economy, exactly when an interest rate hike, or cut, I should say, will come, and what magnitude. Everyone's now talking about 50 basis points in September, with some even suggesting we see an intermeeting cut. We've got our eyes on this, and you better believe that everyone in the world of politics does as well. This is a big deal at the White House. It's a big deal in the Kamala Harris campaign. It's a big deal in the Trump campaign, with so much riding on the economy at this moment. And I will say, in terms of Kamala Harris's own economy, the campaign's own economy, these are boom times. The numbers out today on fundraising, remarkable. Kamala Harris with $310 million in the month of July. This is a campaign that's only a couple of weeks old. Not just more than Donald Trump by a long shot, but 2/3 of this money came from first-time donors. The Harris campaign now has $377 million cash on hand. Donald Trump and his committees pulled in, by the way, $138 million in comparison. Kamala Harris more than 300. So she's more than doubled the Trump haul here and ends up with more cash on hand on a weekend that will be critical for her campaign as she works to pick a running mate. To that end, we're joined right now by Jonathan Tamari at Bloomberg Government, who spent quite a bit of time covering politics in Philadelphia. The veteran of the Philadelphia Inquirer is with us as the world watches the governor, Shapiro, as the potential running mate. Jonathan, welcome back. Is that going to be her pick?
I wish I knew. He's certainly one of the front finalists, and from a political perspective, he makes a lot of sense. He's a very popular governor in the biggest swing state in the country when it comes to the presidential race, and it's a state, Pennsylvania, that also has a lot in common politically with Michigan and Wisconsin. And if a Democrat wins those three states, they're in very, very strong position to win the presidency. So Shapiro offers a lot in that sense, but we don't know exactly how she gets along with him. He brings some questions about how people on the left might react to him, and she's got some other strong options. So we're all watching and waiting.
Well, that's true. And if you want to sound smart at the cocktail party or at the cookout this weekend, Jonathan has a wonderful story put together here, a real primer on Shapiro specifically, with the headline at Bloomberg Government, Shapiro's agility and appeal give him an edge in the running mate race. I've been hearing the name Beshear more often in the past 24 hours than I have in a couple of weeks, Jonathan. It just reminds us that this could still go anyway.
It could, but it does kind of give us a signal of the kind of people that Harris is looking at. Beshear, also an unusually popular governor, especially for a Democrat in Kentucky, somebody who has won over, out of necessity, has won over moderate voters, probably some moderate Republican voters. And so he's not going to put Kentucky in play, but you would think that he can go out to states like Pennsylvania, Michigan, Arizona, and speak to some of the moderate voters that are so critical in all of those places. You know, our understanding, the latest reporting, and as you point out, this is kind of a really fluid situation, is that it does seem to be Shapiro, Governor Walz of Minnesota, Senator Mark Kelly of Arizona. But, you know, it could be a surprise still. We this is such a tightly held decision among such a small group of people. But those are the three whose names have been really at the top of the list so far.
Sure. Well, just looking at the polling we saw yesterday from Public Opinion Strategies, GOP pollster, Pennsylvania, Harris 48, Trump 45. Our poll here in the Bloomberg Swing State poll with Morning Consult this week shows Harris down in Pennsylvania. She's going to start this tour next week in Philadelphia. And we're being told to pay no attention to the selection of the state or city because, gosh, it's happened differently before. But I'm compelled by the chemistry part of this. If geography isn't what drives the decision, we're hearing more about who she's going to get along with, who she wants to travel with, who she can share a stage with, Jonathan. Isn't that Governor Shapiro?
It certainly could be. They've known each other a long time. They're both former prosecutors, former attorneys general in their state. So they do have that connection. But, she's a senator. Mark Kelly was a senator. They're from neighboring states. I don't know what kind of relationship she might have with Governor Walz. So, but it's one of those things like, who knows exactly how well two people click? Governor Shapiro is a person, I think some of his critics would say he's always been very ambitious. He's always been looking for his next step. Some people might wonder whether he would be comfortable being a number two. Even some members of his own party have said they worry that he would maybe try to outshine Kamala Harris. I don't know that would be the case. I think he understands politics very well, but it could be a concern.
I wonder how he would do on a stage with J.D. Vance. You can weigh in on that. But I'm struck by a memory that I have when we were on our way to Milwaukee, the day that Donald Trump was shot in Pennsylvania. Kamala Harris that day was out with Governor Shapiro campaigning. They went to a big food market in Philadelphia, and they were riffing with the press, and they were trying food, and they were taking questions and so forth. And everyone watching this thought, they seem like a potential item here politically someday. And you fast forward a couple of weeks to where we are now, and they do seem to be a couple people who get along, Jonathan, which might be the way this is decided. Also, you add the prospect of an executive, a governor versus a senator, and what that might mean for her politically here to cover some of her tracks on issues. It's an interesting scenario, and I won't ask you when we're going to get an announcement because I realize nobody knows here as we spend time with Jonathan Tamari from Bloomberg Government. I have to ask you about Congress, which you also cover for a living. Everybody's gone. There's an interesting quote in your piece from Jared Moskowitz. It says, "I've been here for 18 months. I feel like I've served a lifetime." What's going to happen when these lawmakers come back from their extended summer break?
Well, I don't think there's going to be a lot that happens in September. And Moskowitz was referring to kind of obviously the 18 months, but also just the last honest month and a half from the presidential debate to an assassination attempt to the Republican convention to Joe Biden dropping out of the race. It's been so tumultuous. I think people are kind of punched out a little bit. I think they've kind of been exhausted. And they're all going to have their eyes on the election for the rest of this year until November. They come back in September. They have a government funding deadline. The wide expectation is that they'll pass something that's short term that kicks it past the election. Nobody wants to own a shutdown just weeks before Election Day. And then whatever work is left will get taken care of after the election. And a lot of it will depend on who wins. If you're incoming President Harris and you know that you're going to have a Democratic House and Senate next year, well, maybe you wait on things. Or if you're an incoming President Trump and you feel like you have an advantage in waiting, maybe you tell your colleagues to not pass any major legislation, to hold off till you have more power. On the other hand, maybe they want to clear out some of the more thorny issues before the new president takes office and not have the president confront, the debt ceiling within the first month of taking office. So there's going to be a lot to do, but I think we won't know what the shape of that will be until we see the outcome of the races.
Two interesting things happened last night. Bob Good, who was chair of the House Freedom Caucus, lost the recount in his race in Virginia. He is going away. Andy Ogles in Tennessee, the Republican who serves on the Freedom Caucus, won his primary. Will he be the next chair of the Freedom Caucus?
Yeah, that's a good question. I think I think we'll have to see who else is kind of incoming into the Freedom Caucus. He's certainly a big name. He's certainly someone who's tried to make his mark, and they cycle through people pretty quickly. They don't allow anybody to hold that position for too long, but he's certainly somebody to watch. He kind of has the profile for it. I think we still have to wait and see if there are other people who are interested in the job.
Well, that'll be quite the battle to cover here when they come back, assuming that this goes the way we think. Jonathan, great to see you. Appreciate, as always, your reporting at Bloomberg Government. Find his piece, as I mentioned, the profile. That was the word I was looking for on Governor Shapiro here as we work our way towards an announcement, whether it's Josh Shapiro or someone else. You'll learn a lot about the Veep stakes and the way the campaign is considering its options at this moment. Is it geography? Is it character? Is it both? We're about to find out together. This could be a newsy weekend. Or we'll show up here on Monday getting ready for the headline. We'll assemble our panel next, their take on everything we've talked about so far this hour. Rick Davis and Jeannie Shanzano are with us after we get you up to date on world and national news. For that, we turn to Nancy Lyons in the Bloomberg 99.1 newsroom here in Washington. Hi, Nancy.
Thanks, Joe. 3 Americans newly released from Russian custody are now in San Antonio, Texas, where they will undergo medical evaluations. Paul Whelan, a Marine veteran and corporate security executive, had been held since 2018. He spoke once arriving in Texas.
I just say thank you to everybody. Thank you for all your prayers, your good wishes. Thanks for doing everything you did. It all helped.
Arriving with Whelan was Wall Street Journal reporter Evan Gerskovich and journalist Alsu Kurmasheva, who has a dual U.S.-Russia citizenship. Well, do not expect to see a debate anytime soon between Donald Trump and Kamala Harris. Trump, appearing on Fox Business's Mornings with Maria, said he does not need to debate the vice president.
If I didn't do the debate, they'd say, oh, Trump's, not doing the debate. That's the same thing they'll say now. I mean, right now I say, why should I do a debate? I'm leading in the polls. And everybody knows her, everybody knows me.
Harris has been pressing Trump to follow through with a scheduled debate on September 10th that was to be hosted by ABC News. As for the polls, a Bloomberg News Morning Consult survey conducted from July 24th through the 28th found Harris erasing Trump's lead among voters in 7 battleground states likely to determine the election. Harris is backed by 48% of voters to 47% for Trump. And over 100 million Americans are under heat warnings and advisories. Forecasters say a high-pressure system is stretching across all parts of the U.S. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Nancy Lyons.
12:40 on Wall Street. We do check markets all day long at Bloomberg. The NASDAQ 100 index in correction territory. A major sell-off on Wall Street this jobs Friday. The Dow, the S&P, NASDAQ deeply in the red. The S&P set for its worst jobs day in 2 years. Right to the numbers with the S&P down 101 now, a decline of 1.9%. Dow Industrials down 715 for the Dow, a drop of 1.8%. NASDAQ is down 2.2%. The NASDAQ 100 index down 2.2%, while the Russell 2000 index of small cap shares tumbling now by 3.3%. We've got the 10-year 3.82% right now. The 2-year 3.92%. The 2-year below 4%. West Texas Intermediate crude oil down 4%, 73.22 a barrel, and spot gold down 0.6%, 24.31 for an ounce of the precious metal. Bitcoin meanwhile down 2.1%, 63,333 on Bitcoin. July's jobs report could clear the way for the Federal Reserve to start cutting rates. With that story, here's Bloomberg's Vinny Del Giudice.
The Fed's benchmark rate is at a 2-decade high. Fed officials started tapping on the economic brakes more than 2 years ago to stop inflation. We may be tapped out. July's 4.3% jobless rate is the highest in almost 3 years. Fed Chair Jerome Powell this week signaled the Fed could start easing in September based on economic data between now and then. He also acknowledged the U.S. labor market is slowing. July's data seemed to affirm that, and futures trading imply the Fed will ease by a full percentage point by the end of the year. Vinny Del Giudice, Bloomberg Radio.
Intel shares after earnings now plunging by 27%. Apple shares after earnings up 3.2%. Amazon after earnings down 8.4%. Again, recapping steep losses for the U.S. stock market. S&P 500 index down 98, a decline right now of 1.7%. Balance of Power continues the Friday edition. What a week it has been. Back we go to Washington. Once again, here he is, your host, Joe Matthew.
Yeah, what a week, Charlie, and the hits keep coming. Thank God we have Charlie Pellet on a day like this trying to make sense of the markets, clearly having a fit over this jobs report, and we're going to be talking more about that in our next hour. Michael McKee will join us. Did the Fed miss its chance is one of the big questions being asked today in Washington, just like Wall Street. And we have breaking news on the campaign on what has been a pretty profitable day, or certainly end to a month for Kamala Harris. Pay no attention to these markets. Harris campaign pulling in $310 million in July, more than twice the Trump campaign and related committees. But we've got a breaker. Politico says it's done. You heard about it. There have been reports out there for weeks. And apparently Kamala Harris has hired David Plouffe as a senior advisor to the campaign. Of course, Barack Obama's campaign manager in 2008, who played a big role in the 2012 re-elect with Jim Messina, who you've heard from many times on this broadcast. Wasn't Plouffe at Twitter or Uber? He went to Uber. Apparently he's back on the road with Kamala Harris, and we've got a lot to talk about with our campaign analysts. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us on the Friday edition of Balance of Power. Rick, you've gone head-to-head with David Plouffe. This is a good move for Kamala Harris to go back to the future?
Yeah, he beat me, so I guess that's a good thing in the war of politics. But yeah, he's a very knowledgeable guy, knows politics, knows presidential politics like very few others, and is a very stabilizing force within a campaign. So I have no doubt he'll bring balance and practicality to this crazy transition that the campaigns had to go through. You know, waking up one day with one candidate and going to bed the next day with a different one. So I'm sure that his talents will be put to good use.
Interesting move here, as it's Barack Obama, who in many ways was behind Joe Biden getting out of the race, Jeannie. Now his old guy from 2008 is going to run or help to run the campaign for Kamala Harris. The fingerprints from the Obamas cannot be missed here.
Oh, they cannot. He was also in a similar role in 2012. So this is, certainly something that I'm not surprised by. And it is, I think, a very good move on their part. As Rick was just saying, this is somebody who knows how to win He's proven that 2 times in a row under pretty difficult circumstances, particularly in 2012. And so I think this is an important change at the top of the campaign for Harris. And she has a right to do this. She has to have people that she brings in that she can trust. This is certainly a different candidate and a different campaign, as much respect and love as she has for Joe Biden. So if Democrats want to win, this is a really good step forward to doing that.
Well, they've got the money to pay him, that's for sure, Rick. What do you make of these numbers here? The Harris campaign and committees report $310 million for July, 2/3 from first-time donors, and more than twice what Trump pulled in, $138 million. She's got more cash on hand. These are pretty remarkable dollar figures to begin a campaign with. How does she use them?
Well, she actually isn't just beginning the campaign with that kind of fundraising. I mean, she had a bunch of cash on hand, over $250 million to begin with. So this is an incredible haul, right? The script is completely flipped, where Donald Trump had the best couple of months of the fundraising cycle recently and had gone ahead of the Biden campaign on cash on hand. And this completely reverses that trend and shows that she now has significantly more money, cash on hand, than the Trump campaign had. And we see it reflecting in actions. They've made decisions at the Harris campaign to buy $50 million worth of TV. And under the same period of time, the Trump campaign has only purchased about $12 million. So when you can put that kind of lead on the target, that kind of advertising in key states, we've seen in Northern Virginia, in my own home area, lots of new campaign ads by the super PAC supporting Kamala Harris. It just shows she has the capability to go to places like Virginia and tie it down, while Donald Trump may be limited to only doing battle in the 6 key swing states.
Amazing. Jeannie, give us perspective on these numbers. $310 million in the first month out of the box.
It is a stunning amount. I don't think if we go back just a week and a week, any of us could expect this amount of energy, this amount of support, this amount from the grassroots, as you just mentioned. They have got to be obviously thrilled. As the campaign reported, they have broken so many fundraising records. It's hard to even keep track of them at this point. And they've got to spend this money wisely. We just mentioned the hiring of Pluff. That's, he's not going to get all of the money, but he'll get a good chunk of it, I suppose. But the big thing they have to do is they've got to get out and with advertising. And I will tell you, they have money when you're sitting in New York, in Westchester County, where I am, watching the Olympics, and you see not just 1 or 2, but multiple television buys by the campaign and by their affiliated groups. They have the money to spend. They're not just spending them in the swing states where, to Rick's point, Trump may have to focus with his more limited budget. They are spending across the nation. So at television advertising is one key, because she has a job to do. We can't forget. She has got to define herself before Donald Trump does, and she has got to remind people who Donald Trump is and ask them if they want to go back. Yeah. And that takes money, and she has the money now to do that.
If somebody showered you with $300 million, Rick, in a case like this, would you just be in the studio making commercials? How would you be spending your days?
No, it's a combination of things. Obviously, one of the most expensive features of a campaign is broadcast TV, but most people's campaign budgets now include almost as much on social media. The Biden campaign, and in extension, the Harris campaign, has invested incredibly heavily, both at the campaign and the DNC level, with a ground game. They have more offices, more paid staffers on the ground in these key targeted states than anything close to being on the Republican side. And so when you are able to match spending where you're outspending your rival 2, 3, 4 to 1 on TV and social media, and you've got a much more extensive ground game fueled by that same kind of cash, you start to build really great options. And that's all that they're doing right now is what states can we put in play? What states can we turn that were otherwise looking like they were trending Trump away from Biden, and now we can pull them in toward Harris. She can extend the map and go into places that otherwise Republicans would not have been trying to spend money to defend. So believe me, John McCain's campaign got outspent 3-1 by Barack Obama. And our strategy was how many few states can we play in and still win, when their campaign strategy was how many more states can we turn on to spread the McCain campaign thin. And, you'd much rather be the latter than the former.
Fascinating. I've got to ask you about the debate and whether we're going to have one. As you've been hearing on Bloomberg, Donald Trump tells Maria Bartiromo, well, why should I do a debate? I'm leading in the polls, he said. Everybody knows her. Everybody knows me. You could have said the same, of course, about Joe Biden. But, Jeannie, based on what we're hearing, this is never going to happen, right?
I think, his campaign is telling him it's not a wise move. You already did it once. You did what you needed to do, or your opponent imploded, and don't go back and try it again, because he didn't have a very good debate. It was just that Joe Biden had such a bad one. It overshadowed Donald Trump's. So I don't think they want him to get out there and do this. And I think that Harris has met this with the right line, which she has been saying over and over. If you have something to say, come debate me, say it to my face. And that has been a huge applause line as she has been out on the stump. And I think we're going to hear that, he and JD Vance keep talking about her. Well, why don't you come and say it to my face? And there has been reporting that even at Trump's rallies, his supporters want him to debate. They don't see any reason he wouldn't, because they think he's going to wipe the floor with her like he did with Joe Biden. Right. So he's going to get a lot of pressure to get out there. And boy, do I personally want to see this debate, Joe Matthew. So I've got my
you better believe
fingers crossed that he changes his mind.
And you will be with us here if it does happen. I suppose he could be goaded into this, Rick, just based on his personality. But from a campaign standpoint, from a political standpoint, what would be the trigger? What would force him to have to debate Kamala Harris?
I think a continuous decline in the polls. Nothing speaks more loudly than losing. And I think if, this time a month from now, they have not righted the ship and she continues to press her advantage in some of these key swing states, the brass in the Mar-a-Lago campaign office are going to get together and say, we've got to stop the bleeding. We've got to turn the tide. Nothing has the impact of getting more people to tune in to the campaign and see your candidate than the expectation of a presidential debate. And so they may be in a situation where they have to debate. If he believes he's winning, then he probably won't debate. But at some point in time, he may be in the position where he needs it more than she does.
Yeah, that's the calculation. Nothing speaks more loudly than losing. Rick Davis, the 2nd of August, 2024. I'll tell you what, Jeannie, we spent the first half of this hour talking about the economy, the jobs report today, the market's falling out of bed. Is that Kamala Harris's biggest worry right now?
I do think it is obviously a concern, but unlike Joe Biden, while she is vice president and she hugs tight to him, she's not going to have to own it to the degree that he does. And by the way, can I just add, what polls is Donald Trump looking at when he says we're up? I'm looking at Real Clear Politics right now, and he's at plus 1.2%, which is within the margin of error of any poll. So I think he needs to look at his numbers again.
Well, yeah, that's very much. Look, things have changed a lot over the past couple of weeks. Jeannie, maybe they're not showing him, by the way, all of those numbers. Do you think, Rick, is Donald Trump getting the same public polling that we are?
Sure, yeah. Nobody peruses TV and social media as much as he does. He knows what's going on around him. He's self-aware. I don't think this is a case like what I think was reported around Joe Biden, where he may simply not have known just how bad the campaign polling looks. So, no, he knows what he's into. He's not going to suffer fools gladly. He's going to be able to assess whether or not he really believes his own spin that he's winning. you really can't tell the difference between what he believes and then what he says may be diametrically opposite. And so you just can't rule out anything when it comes to Donald Trump.
Jeannie Shanzano and Rick Davis stay with us. Our signature panel back in hour 2 as we talk about the prospect of a debate and the impact of this economic news today on the campaign trail. You want to stay with us with much more ahead. This is Bloomberg.
politics to the world of business. This is Balance of Power. Live from Washington, D.C.
Jobs Day disappoints, markets see red, and the political implications could be huge. Welcome to the fastest show in politics. As today's jobs report points to weakness and gives new fuel to the hard landing crowd, I'm Joe Matthew alongside Kaylee Lines in Washington. That, Kaylee, would not be good news
for the Kamala Harris campaign on a day we would otherwise be celebrating BAFO fundraising numbers for her.
Yeah, $310 million, no small figure, but you're exactly right, Joe. Not only is this bad news potentially for who is effectively the incumbent presidential candidate, but of course it's bad news for the equity market as well. We're looking at potentially the worst jobs day reaction the S&P 500 has seen in 2 years, but massive buying coming into the bond market.
Yeah.
We're down 24 basis points on the 2-year yield on the day as people are now pricing in potentially more aggressive Fed rate cuts just around the corner.
Yeah, stocks are hurting too. You've got the S&P 500 down over 2%. That's been the case for the balance of the day here, Kaylee, and it's not what Democrats want to be talking about as they head for their convention this month in Chicago.
Indeed, it's just weeks away. We'll have much more on the political implications this hour. But first, let's get you a full update on this market action we're seeing on this jobs day. Charlie Pellet has that for us up in New York. Hey, Charlie.
Indeed. Right now, Kaylee Lines, we are looking at the worst jobs day for the S&P 500 index in almost 2 years. Indeed, Wall Street's fear gauge, the VIX, soaring towards its highest level since 2022. Right to the numbers, a lot of red here with the S&P down 117, down 2.1%. Dow Industrials down 781, down 1.9%, while NASDAQ now down 453, a decline there of 2.6%. The 10-year at 3.81% with a 2-year 3.90%. And we have got gold, spot gold down 0.7%, 24.30 the ounce, while West Texas Intermediate crude oil right now down by 3.9%, 73.31 for a barrel of WTI. Our just meant we'll have a whole lot more on the markets coming up in just a moment. Not all about the jobs report. Indeed, a lot of reaction to earnings. Intel plunging 27.7% after last night's report. We've got Amazon trading lower now by 9.8%. Apple shares, though, after earnings up by 2.7%. Again, recapping, we got the S&P on track for its worst day in reaction to jobs data in almost 2 years. S&P now down by 2.2%. I'm Charlie Pellet. Balance of Power continues now. Back we go to Washington. Joe Matthew and Kaylee Lines.
All right, Charlie Pellet in New York, thank you so much. I'm Kaylee Lines alongside Joe Matthew. Welcome to Balance of Power on this jobs day. We've been talking a lot, Joe, about how the economy was looking pretty good, and yet the incumbent administration wasn't getting credit for it.
That's right.
The question is, are they going to get the credit now that it does seem that things are turning south?
Well, that's true, certainly in terms of the markets and an economy that just seems to be slowing more quickly than anyone was talking about, even just a couple of weeks ago here. And a big question about whether the Fed has missed an opportunity, with now some folks calling for a rate cut before we even get to the meeting in September, and those looking to September are talking about 50, not 25 at this point. Austin Goolsbee spoke earlier to Michael McKee and Shonali Bosick as part of our coverage here on Bloomberg. He was really trying to tamp down the fear, a single data point does not make a trend and so forth. The Fed's got to be concerned about this too.
Yeah, of course they will, presuming that they decide not to make any decisions on rate cuts until their next meeting, get another jobs report before then. But of course, it wasn't just the figures today. You had weak manufacturing data yesterday. You had initial jobless claims at levels that we hadn't seen in some time. So it collectively is what is causing markets to see a bit more of a picture of things deteriorating, and perhaps in a way that the Fed did not expect.
And it's one of those days where here on the political show, we're spending a lot of time talking about the markets with a lot of crossover. Kamala Harris may not be tweeting at Jay Powell the way Donald Trump used to, or crowing about highs in the stock market, but there are huge implications here. And we want to start with Michael McKee, who, as I mentioned, did talk to Austin Goolsbee a little bit earlier. Michael, this whole idea that the Fed missed the opportunity, what is the conversation at the FOMC today?
Well, the first thing they will tell you is what they always say: we don't look at one data point and make a decision or a conclusion based on that. And so Austin Goolsbee's reaction was, this was not a great report, but it is not a terrible, terrible report. And overall, the economy still seems relatively strong. So let's see what we get going forward. And it is true that markets, their initial response to everything is basically to overreact as people pile in on a momentum trade. And then, people start to pull back and think about what they have actually seen. And so I think the Fed is expecting that as the weeks go on, we will see a little more calm, unless for some reason jobless claims explode, something like that. And then we'll get another payrolls report at the beginning of September before the next Fed meeting. So they'll have an opportunity to see if this is a one-off kind of situation or if this is a really bad trend.
Well, it's not just markets that are reacting, though, Mike. It's not just traders here. It's also economists across Wall Street banks that are essentially revising their forecasts for Fed cuts. You now have JP Morgan and Citi calling for not just a 50 basis point cut in September, but November too, and potentially cutting at every meeting after that. How high is the bar for the Fed not just to cut, but to cut by half a point?
Well, Fed officials would say it is quite a high bar. Jay Powell was asked about it at his news conference on Wednesday, and he said, we're not even thinking about that right now. I think you would need several other data points besides this one that told the Fed that the economy was really in trouble, and then they might do 50. The reaction was interesting because we had even JP Morgan suggesting that maybe the Fed wants to cut intermeeting. So we've gone from a fairly strong economy in Jay Powell's view on Wednesday to a crisis. And, the Fed's going to take a breather before it adopts any crisis fighting activities.
All right, Bloomberg's Michael McKee, our international economics and policy correspondent. Thank you so much for walking us through how the Fed is likely viewing this, as it is abundantly clear how the market is viewing this today. Although it's not just about Jobs Day. We also had some pretty disappointing earnings from the likes of Intel. That stock right now down 27% on the day. For more, let's bring in Jess Menton, who covers equities for us, where she is a senior reporter here at Bloomberg. So, Jess, obviously it's hard to kind of separate what's happening in tech with what's happening in the wider market. To what extent do we attribute this to micro and to macro?
Well, that's a great point, Kaylee, because obviously to what we were just talking about here with Mike McKee, and especially the trend when it comes to data points like this, that's what traders always want to say. And actually going into the Fed decision from Fed Chair Jerome Powell, what he was going to signal on Wednesday, a lot of them were expecting a potentially sell the news type moment. We did get a huge rally that afternoon, but since then, of course, a lot of people want to point to some of these data points like the manufacturing data yesterday, and of course the jobs report this morning. But when you had a huge run in really speculative corners of the market like the Russell 2000, where everybody's been talking about, especially the last year, wanting to see this rally broaden out. But if you look at the Russell in particular, of course it's been cheap, especially on the valuation side for that. But because of the massive rally and the historic outperformance it had relative to large caps last month, it's not quite as cheap as it had been. So that was more of a trade than a longer term investment, just because the earnings outlook still remains elusive. So now a lot of traders are turning more toward dividend type paying corners of the market that obviously will benefit more toward rate cuts. So even though some of the gains here for some of those dividend pairs gave up some steam this morning, if you look at the flows on a weekly basis, especially when it comes to utilities as well as real estate, they've been on a tear and they are going to benefit. And of course, utilities, obviously there's an AI play element to that, but even beyond some of the power and sort of renewable side of that, if you think of gas utilities, water utilities, those are ones that are doing very well right now, and that's where a lot of the money is flowing.
I'm really glad that you brought up the IWM in this case, Jess. There have been so many people talking about a rotation over the past couple of weeks, and the Tom Lees of the world have been piling money into small caps, waiting for the moment that the Fed starts to cut. It's down 3.5% again today on top of recent losses, knowing that something like half the components of the index don't make money. Is that trade actually over?
That's right, because a lot of that comes down to the amount of zombie companies that are in the Russell 2000. It's a little bit different if you look at the S&P 600 that obviously holds small cap companies. Those tend to generate better earnings growth, but our own GMA, Gina Martin Adams, follows, as well as Mike Casper, obviously the small cap story very closely here. And a lot of that has to do with the revenue outlook moving forward, and especially not just large cap in the midst of earnings season, but also small caps as well. But the issue there is when you have companies like Super Micro that were formerly small cap stocks that get very big, as well as MicroStrategy, and they graduate from that index and move over to other indexes like in the Russell 1000, that makes it harder for the earnings outlook overall for that particular index to improve there. So that's where the side of the equation, because it's gotten more expensive now. So really it's down to whether or not they deliver on the profit as well as the revenue outlook.
We'll keep eyes on it with your help, Jess Menton. We do appreciate it. Bloomberg senior equities reporter with us on a tough day here on Wall Street, this jobs day that we'll keep talking about throughout the hour here, along with politics. A big crossover here, Kaylee Lyons, when we consider the future prospects of Democrats, namely Kamala Harris right now trying to gin up a campaign with a huge influx of cash, but a messaging problem when it comes to the biggest story, the biggest issue on the campaign trail, that's inflation and the economy. Now the question, did the Fed miss the mark?
Yeah, absolutely. And of course, we're likely to hear a lot about this from the Trump campaign in regard to not just the economy, but the way in which he would like to address it. What we've heard consistently from the former president is this idea that deregulation is going to be one of the ways that he tries to bring prices down and help bolster the economy. And it's regulators that we know have gotten a lot of scrutiny from Republicans in general under this administration.
When we consider the eye on the consumer, we turn to the director of the Consumer Financial Protection Bureau in a conversation that we've been looking forward to bringing you here on Bloomberg. Rohit Chopra is with us from World Headquarters in New York. Director Chopra, it's great to see you. Welcome back to Bloomberg TV and Radio. You've been an awfully busy man recently, putting forth new rules that apply regulations to credit card late fees, buy now, pay later, getting an advance on your paycheck, even large asset managers. What's your priority this summer?
Well, one of the things that we're always going to be focused on is trying to lower some of the prices, including corporate gouging by some of these companies. We're seeing how firms, including big credit card companies, exploiting old regulatory loopholes, even dating back decades. And we're putting a stop to a lot of it. It's going to save households a lot of money. We hear all the time from special interests that there's going to be consequences that are harmful. It's not going to bear out because this is really about making sure the law is being followed and consumers are being treated fairly.
Well, of course, it doesn't really stop there. When we look at your agenda and the rules you've been passing recently, you also made some proposed tweaks to the Change in Bank Control Act. Could you just clarify, as you're looking at these larger asset managers, what this change actually is going to mean in reality for the likes of BlackRock or other giants out there?
Well, there's been a real rethinking when it comes to mergers and merger review. I used to serve as a commissioner on the FTC, and the status quo 5 years ago was just to be a rubber stamp. But we're now seeing much more rigorous merger review across sectors. And when it comes to banks, that's no different. We're looking much harder at all sorts of bank acquisitions to make sure that it's not reducing competition, that consumers can get good rates no matter where they go. Now, you asked specifically about BlackRock and other big asset managers. We're really starting to scrutinize whether these companies are truly being passive. Part of the way they have avoided scrutiny of their acquisitions is they say, we're not doing this to take control like a normal merger or normal acquisition. We're just a passive investor. But we want to make sure that they're truly being passive and not the ones calling the shots.
I want to ask you about buy now, pay later, which has been such a massive trend, and companies like Affirm have been rewarded for it on Wall Street. Your new rules are somewhat interpretive here, and some consumer groups, even some banks, have asked you to strengthen these rules, to go a bit further, to mandate a borrower's ability to repay, for instance, and even bring firms like the one I mentioned under your direct supervision. Is that something that should happen?
Well, buy now, pay later got big during the pandemic. It grew about tenfold from 2019 to 2021. And we're seeing it as an option in almost every single online checkout. But you know, buy now, pay later has to be treating people fairly. They have to be upfront with all the key terms. So we're making it very clear that no matter what you call yourself, you have to make sure you follow the laws that apply to credit. We think there are tens of billions of dollars of transactions that buy now, pay later consumers are really on the hook for. So I do think we're going to have to keep scrutinizing these firms, but at the end of the day, we want it to be an option for people that they can compare side by side, and we want these companies to compete on service and price and not exploit regulatory loopholes.
Well, Sir, of course, when we consider buy now, pay later, it plays into this entire notion of the fact that consumers are piling up on debt more now that all those pandemic era savings have been depleted, and especially in light of data that we're seeing, including what we got, a softer jobs report today. Are you worried from your perch looking at consumers and their financial health that real cracks are starting to emerge, that we could start to see more delinquencies? Now, what are you bracing for?
It's really interesting. 2 years ago, we really thought those delinquencies were going to accelerate much more quickly. And in fact, we have returned to normal. In some places, I do see some worrisome signs in subprime auto, in parts of the credit card market. But we're going to be fixated to look at where that debt is and how it's performing. I do worry that some of the credit card interest rates that people are paying are just so much higher than they were paying before. And that's not just due to changes in monetary policy. Credit card issuers have pumped up the margins that they've been charging now, and Americans are paying about $105 billion just in interest. And often that interest can really put them on a treadmill. So we are looking hard at credit cards, at auto loans, and of course mortgages. So far, we see a little bit of stress, and we want to make sure we're taking the right steps that it doesn't spread. And I will just share, there's just no question that the higher rate environment has really hit American households on all types of things. Of course, mortgages being the biggest, but credit cards and auto loans really hitting people's pockets.
I want to ask you in our remaining moment or so, Rohit, about funding. Now that the Supreme Court has validated the Bureau's funding structure, I wonder if you feel more confident moving forward with rulemaking, and what would happen if Donald Trump was elected president?
Well, you know, we did prevail in the Supreme Court in a decision authored by Clarence Thomas that made totally clear that our funding is legal. I really think the banking industry has benefited from the CFPB. We really have taken out a lot of scammers and fraudsters and really focused on some of the pain points for consumers that they're facing. So, you know, I don't like to predict about what will happen in the future, but here's what I will say. The work that we've been doing to take on some of these junk fee abuses, to let people switch their banking products and credit cards more easily, to embrace how new technology can open up new opportunities, that's only controversial in Washington. Everywhere else, that's what they want to see their government do, is look to the future and help people protect their finances so that they can build their future.
All right, Director Chopra, we appreciate you joining us here on Balance of Power. Thank you so much for your time, sir. That, of course, was Rohit Chopra, Director of the Consumer Financial Protection Bureau, joining us today from New York. I'm Kaylee Lyons alongside Joe Matthew here in Washington. We'll have much more still ahead on today's weak jobs report and the potential political ramifications. Our signature political panel, Rick and Jeannie, are next on Bloomberg TV and radio.
everyone on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story and a headline off the Bloomberg Professional Service. Dun & Bradstreet said to be exploring a sale amid takeover interest. That from Reuters. Right now, we've got Dun & Bradstreet shares surging by 20.1%. All of this on a down day for the U.S. stock market. S&P 500 index on track for its worst jobs day in 2 years. S&P right now down 120 points, a decline of 2.2%. Dow Industrials down 844, down 2%. NASDAQ lower by 454 points, a decline of 2.6%. The 10-year at 3.81%, with a 2-year this jobs Friday, 3.90%. Spot gold down 0.8%, 24.27 the ounce. West Texas Intermediate crude oil down 3.7%, 73.47 for a barrel of WTI. Bitcoin right now is trading lower. We got Bitcoin down by 2.4%, 63,159. Chevron is relocating its headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime is making it a tough place to do business. Today, Chevron shares, they're lower now by 3.5% after earnings. ExxonMobil down 0.6%. Again, recapping steep losses for the U.S. stock market, with the S&P down 120, a drop now of 2.2%. Balance of Power continues the Friday edition. Lots going on. Back we go to Washington, and once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, we thank you as always for keeping tabs on the markets, even if it's tough news today. Welcome to the fastest show in politics. I'm Joe Matthew, alongside Kaylee Lyons in Washington, where we turn our attention back to the campaign trail. All this economic news and the direction of the markets resonating, along with the idea of a debate. We still don't even have a running mate here. And the back and forth between the Kamala Harris campaign and the Donald Trump campaign has been pretty rich. We just got a statement, in fact, from the Harris for President camp from co-chair Cedric Richmond. Donald Trump needs to man up, he writes. Since he talks the talk, he should walk the walk. And as Vice President Harris said earlier this week, say it to her face, September 10th, she'll be there waiting to see if he'll show up. Injecting now the prospect of an empty chair debate. This statement follows something Donald Trump said this morning to Maria Bartiromo on Fox Business. Let's listen.
Are you going to debate her?
Well, I want to. We're leading in the polls, it seems, by quite a bit still. She's better than he is, but I think ultimately she'll be worse than him. She's more radical than him.
All right, so let's get into this now with our signature political panel on this Friday. Joe, Jeannie Shanzano, Senior Democracy Fellow with the Center of the Study of the Presidency in Congress, and Rick Davis, Stone Court Capital Partner. Always great to see you two on a Friday as we look ahead to September 10th and wonder if we're going to see anything at all that night. Jeannie, do you really think this depends on the polls?
It should depend on the polls. And if you're looking at the polls, they are neck and neck, whether they are national or in the swing states. We've seen, and even in the Bloomberg poll, where the trajectory is much more positive for Kamala Harris than it was for Joe Biden. So if you're going to go by what Donald Trump said, he should be out there to debate her on September 10th, and I hope he is. I think the fact is that his campaign advisors are telling him he only is going to lose by debating her, so he's trying to come up with some excuse to avoid that. But in the end, Kaylee, I hope we see it because it's going to be must-watch TV.
Well, that's for sure, Rick. What's your take on this? Because I know that you wouldn't put Donald Trump in the ring with Kamala Harris. But if he's not leading on the polls, won't he have to?
Yeah, just to take a step back, I think every presidential candidate, the nominee of the two major parties, has an obligation to the public to debate, right? This is not just about who's ahead and who's behind. I mean, those are technical consequences of saying yes or no to a debate request. But there's an overriding public interest here. The public should be able to see Donald Trump in action and Kamala Harris in action and make judgments based on that. And they should be after they've been nominees, not before. And it should be a part of the fall election. That is our tradition as a democracy. And so that's saying I don't think there's going to be a debate because I don't think it's in Donald Trump's interest. I think he probably is concerned with his ability to debate head-to-head Kamala Harris. And I'm pretty confident that he's not going to believe that that debate's going to result in an uplift in the polls. If anything, maybe downdraft. And why take the risk in September, October? Look, remember, he's going to say he won no matter what the outcome is. So why do anything that gets in the way of, his narrative about he's already won this election?
Does what applies to Donald Trump, Rick, also apply to his vice presidential nominee, J.D. Vance? Do you expect we'll see Vance on a stage with whoever Kamala Harris decides is going to be her running mate in the next few days?
I doubt it. I think that what's good for the goose is good for the gander. And in this case, my guess is that because we don't have a commission on debate sponsoring these debates, right, they've already rejected their participation, then it would be up to the two campaigns to formulate a strategy around trying to put a debate together. And in this case, I can't imagine Donald Trump wouldn't understand that if the VPs debate, there's going to be immense pressure on him to do the same. And so he'd only be hurting his own prospects if he's trying to avoid a debate by letting Vance debate.
The debate is not all Donald Trump has been talking about in the last 24 hours. Yesterday, we were describing him doubling down on his questioning of Kamala Harris's racial identity. Today, he is tripling down, I guess is the only way to put it, posting a photo on Truth Social of Kamala Harris dressed in a sari with a caption saying, "Your warmth, friendship, and love of your Indian heritage are very much appreciated," unquote. Also reposting stuff from Laura Loomer with copies of Kamala Harris's birth certificate. This is starting to sound familiar. Spreading accusations as well that Kamala Harris lied about her race. We were all commenting on an ex-post from Simone Biles. You probably saw Jeannie after winning her 9th Olympic medal, quote, "I love my black job," with a black heart. Where is this whole thing going? How do you go beyond the tripling down on this strategy for Donald Trump?
Yeah, first of all, what a night for Simone Biles. That was just amazing to watch. So proud of her. It was, I loved it. So the reality is we are back to the future with Donald Trump. And it's unfortunate for Republicans because if you're looking at a strategy to take on Kamala Harris in a serious way, this repeat of birtherism dressed as something else is not the way to do it. What is Bloomberg talking about today? They are talking about these numbers and the impact on the market. You've seen people like Jason Smith. You've seen people like Rick Scott try to tie this to Kamala Harris. I don't happen to agree, but wouldn't those kinds of policy approaches be much more effective for Donald Trump? And instead, he goes back to his, quite frankly, racist tropes and who, seems to be frightened of taking on a woman on the debate stage again. And so here we go again. And so I think it's unfortunate for Republicans, quite frankly, who are going to have to go through this. But we have to face it. He's what he set out to do, which is to gain a lot of free media attention on the back of this.
Well, certainly attention is being paid. Now, speaking of media attention, some media breaking news for you. Headlines just crossing the Bloomberg terminal that Kamala Harris has enough delegates to win the Democratic nomination. This, of course, as the DNC had their virtual roll call underway. They will close voting on her nomination on Monday. The DNC chair, Jamie Harrison, saying he's proud to confirm that Harris earned more than a majority of votes from all convention delegates and will be the nominee following that close of voting. Now, of course, we're looking to Monday to figure out when she may make a vice presidential pick, Jeannie, but there's also things swirling about a potential cabinet, including a Washington Post op-ed today in which Jamie Dimon, the CEO of JP Morgan Chase, makes the case for someone from the private sector getting a cabinet seat. He writes in part, quote, "The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table." What do you think about that, Jeannie?
I'm so glad he wrote this piece. I think the idea that we need to restore faith in America is something we can all get behind. I think there's a lot of questions about how best to do that. I think it is really important to consider having representation from the private sector in the government and in the cabinet. So I think that makes good sense. I, of course, have my own view of what we need to do, which I'm happy to talk to Mr. Diamond about, which is restructuring. But I do think diversity in the cabinet by way of background and talent is critically important. I don't think we can forget we've had that in the recent past, and we've had that historically. I don't know if it's enough, but it may be a good first step.
Presidents may invite executives over to the White House for counsel, Rick, but they're not going to allow private sector at the table in the cabinet, are they?
Sure. Yeah, there's a strong tradition of private sector individuals serving in cabinet high-level posts throughout any administration, and I think. How
about representing the private sector?
It would be an interesting twist. It is basically what the Secretary of Commerce is charged to do, right? Is to promote and represent the business interests, both domestically and abroad. So there are a lot of components to that, right? Obviously, our trade negotiators do the same thing on trade issues. So there is already a pretty significant focus by the federal government in the private sector lives of business community. But at the end of the day, the real question, I think, is not whether or not their views are held or whether or not the approach to government is going to be heavy regulation or lighter regulation. That is one of the fundamental differences between potentially a President Harris and a President Trump. And I think, if we could get back to talking about the issues in this campaign, those would be the kinds of things I think that could draw a lot of voters to one side or the other.
Rick Davis and Jeannie Shanzano will be back with us in the late edition of Balance of Power that starts at 5 p.m. Washington time. Many thanks to both of you. Great analysis, as always, from Rick and Jeannie. As we turn our attention to the latest world and national news, Nancy Lyons joins from the Bloomberg 99.1 newsroom in Washington. Hi, Nancy.
Thanks, Joe. Vice President Kamala Harris has secured enough votes from Democratic delegates to officially be the party's nominee for president. That's the word from the chair of the party, Jamie Harrison. The online voting process will continue until it wraps up on Monday. This is what Harris had to say when she spoke with the delegates today.
I am honored to be the presumptive Democratic nominee for President of the United States, and I will tell you the tireless work of our delegates, our state leaders, and staff has been pivotal in making this moment possible.
The voting was moved online to meet an August 7th deadline for endorsed candidates to make the Ohio ballot. She says she's honored to be the presumptive Democratic nominee. Harris's campaign says it raised $310 million in July. That far outpaces former President Trump's contributions of nearly $139 million. Two-thirds of the donors to Harris's race were first-time donors. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
Reporting on Wall Street, we do check markets all day long here at Bloomberg. S&P 500 index set for its worst jobs day in 2 years. Right to the numbers, with the S&P now trading at 53.18. It is down 128 points, a decline right now of 2.4%. Dow Industrials down 855, a drop of 2.1%, while the NASDAQ Composite Index is down 492 points for NASDAQ, a drop now of 2.9%. The Russell 2000 Index of small cap shares now down 3.7%. We've got the 10-year at 3.81%, the 2-year 3.90%, and spot gold down $16 the ounce, down 0.7%. West Texas Intermediate crude down 4%, now 73.24 a barrel. Intel is suffering its biggest decline in over 40 years after the chipmaker gave a grim growth forecast and laid out plans to slash 15,000 jobs. Intel now lower by 27%. Amazon, after earnings, down 10.1%. And Apple, which also reported last night, Apple shares are higher, holding on to a gain now of 2.8%. Again, recapping, stocks lower across the board, steep losses, in fact, with the S&P now down by 2.4%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at the market reaction on this jobs day. That reaction, of course, in the equity markets plunging to the downside. But we are trying to see some positive spin on this coming from the Biden administration, at least from the acting Secretary of Labor, Julie Su, who was here on Bloomberg TV and radio earlier today and had this to say about the softer print.
We continue, know that there's continued work left to do to make sure that we maintain a strong economy, but we're still at a 3-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
Let's get the word from Bloomberg Economics, where Anna Wong is the chief U.S. economist. Anna, it's good to see you on this jobs day. I've been asking you indicator after data point, is this the soft landing? I have to ask you now, is this the hard landing?
I think it's looking like that way. So you have seen the narratives of soft landing completely appended by all the data this week. And a lot of people, a lot of economists who had previously thought that soft landing was a shoo-in is now sounding quite panicky. So I think this is our view is that the SOM rule, or whatever recession rules, had long, other recession rules have long been triggered. I think the non-linear point in the labor market, in the unemployment, where things should go sharply deteriorate thereafter, that point has already passed. The Fed has an opportunity to cut in July, but they didn't take it. And even doing so, they probably were late. But now they're definitely late. And this is the reason why market pricings are for a dramatic 50 bips rate cut in September. And there's even some options now pricing for an intermeeting period cut before the September meeting.
Yeah, well, that's something that Democratic Senator Elizabeth Warren is pushing for. She posted on X today that the Powell made a serious mistake not cutting interest rates. He'd been warned over and over that waiting too long risks driving the economy into the ditch. The jobs data is flashing red. She goes on to say, Anna, Powell needs to cancel his summer vacation and cut rates now, not wait 6 weeks. What's more likely in your mind, that the Fed would move ahead with an intermeeting cut, or that they would cut 50 full basis points at the next one?
I think both are not our baseline. So there are two things to think about. One is what the Fed should do versus what the Fed will do. In terms of should do, yes, the Fed should be cutting 50 bips to catch up for the missed cuts that they should have done. But in terms of what they will do, we have heard from Powell, and from his body language and from his words, he was very clear that he and the other committee members are very far away from thinking about the 50 bips cut. It is a possibility, though. So in this case, I think the market is ahead of itself, and definitely the chance for an intermeeting cut is even slimmer. Note that we still have 2 more inflation report and another jobs report I think that while the increase in unemployment rate today to 4.3%, a lot of it is real, reflecting underlying weakness in the labor market. A little bit of that is due to the Hurricane Beryl, which could revert in the next meeting. But I think all in all, I think the trend is still for the unemployment rate to reach 4.5% by the end of this year, compared to the Fed forecast of 4.0% back in June.
Well, how quickly things can change. Anna Wong of Bloomberg Economics, our chief U.S. economist, thank you so much for joining us on this Jobs Day. And of course, we've been speaking so much, Joe, before today even, about the notion that if the Fed were even to cut 25 basis points in September, given the proximity to the election, that it could be seen as political. How political would a 50 basis point rate cut be seen as?
Or one that doesn't even happen in a meeting.
Well, there's that.
It's been a long time since we've had one of those, and imagine what headlines could be about on a day when that happens. It's going to get more precarious as we draw our way closer here, but we'll obviously be covering this very closely in Washington at the same time as we cover this campaign. And we had breaking news a short time ago, Kamala Harris gathering the delegates needed in a virtual roll call to actually secure the Democratic nomination, which makes us ask, of course, what's Chicago all about anyway? Kristen Hahn is with us, I'm glad to say, partner at Rock Solutions, one of the most connected Democratic operatives in Washington who we've stayed in touch with closely since this turnabout at the top of the Democratic ticket. And Kristen, I wonder your thoughts now that Kamala Harris technically has it in the bag. She's got $300 million from the last month, and she's now challenging Donald Trump to a debate. But headlines like we have today on the job market, concerns about interest rates, the potential for a recession to coincide with this election leaves us with a fraught landscape, doesn't it?
I mean, I think, and jobs and the economy are always going to be central to any candidate, any election, any presidential election, and who wins. So, you know, I think she's had she's a very strong candidate. Democrats are united behind her. There was no question that she was going to be the nominee going into this process today through the weekend. But, you know, at the end of the day, and she has, and she will, and if you see stuff coming out of the campaign, you need to talk about, you know, kitchen table issues, which are, you know, are people able to survive in this economy? Are they able to put food on the table? And that will be central to any, you know, the campaign going forward.
Well, so when we consider that she effectively is the incumbent here, since Biden is not running, to what extent will she face the same amount of blame that Joe Biden was getting for the economy from serving as his vice president? Are voters likely to see any real difference between them on this issue?
I think that they will. I mean, I think that she certainly won't get the same, you know, criticisms that Biden will. She's in a lot of ways, when we go to Chicago, introducing herself to the American people and has the opportunity to talk about what she might do going forward, might do differently. I don't think there's the same amount of baggage there, but there's some to overcome for sure.
Talk to us about the debate. We had a conversation with Rick and Jeannie about this earlier this hour. Donald Trump's telling Fox Business News today that why should he debate? He's up in the polls. They already know who we are. Of course, he could have said the same thing with more credibility, actually, when it came to himself and Joe Biden. She's goading him. The campaign's out with a statement essentially calling him a scaredy cat. What triggers Donald Trump to the stage?
I mean, I think, you know, calling him a scaredy cat triggers him to the stage, but I think he never likes to look weak. And when she is looking straight to camera like she did in her rally and said, if you want to say something to me, say it to my face. I think in this circumstance, him not debating her makes him look weak, and he doesn't like to look weak. I also like her chances going into this debate of looking very strong coming out of that, and that's something that will be, you know, very different than what we saw in the last debate. I think you see President Trump talking a lot about, you know, he keeps wanting to reference Biden, and it's like, you're not running against Biden anymore. You're running against Kamala Harris. So, you know, I think there's a reason why they don't want to do it, and you might actually have to prep for this one.
Well, and it's not just a question of whether we're going to see the presidential candidates debate, but vice presidential as well. We don't know if we'll see Senator J.D. Vance on the stage with ... whoever she picks by next Tuesday, we expect. What are you hearing on that front, Kristen?
I think she's having these conversations. We have just so many great, you know, people out there that can fill this role, and it's all about who she feels comfortable with, who makes the ticket stronger. You know, it's not necessarily, are you a governor, are you a senator? It's It's, you know, what maybe can that person do to fill up some of the gaps and she believes makes the ticket stronger? And I would take any of these people that we're discussing up against J.D. Vance like all day long, every day.
I mentioned the nominating contest. Do you worry about the impression that that makes? Why not wait to Chicago and actually have a real roll call after what happened? These are extraordinary circumstances for Democrats this time.
They are. I don't think it's going to make that much of a difference, honestly.
It doesn't smack of backroom deals.
It doesn't, and honestly, I know this is getting into the nitty-gritty of it, but, you know, if you look at Ohio, there was a chance that, you know,
Yes,
if
sure.
we didn't do this, and then if people don't remember, we had to delay the Democratic Convention because of the Olympics. So this is way later than it normally would have happened. So the decision was made back in the in the spring, to go to do this early just in case. Now, Ohio, the state legislature fixed the problem, but, you know, I'm a Democrat. I don't want to rely on Republican state legislatures who might go back on their word and go ahead and get this done, and then we can have the celebration and the introduction and education to the American people of who she is in Chicago.
So if we consider that the vice president of the United States still needs to be introduced to the American people to a large extent after being a breath away from the presidency for 3.5 years, how hard is it going to be to introduce any of these vice presidential candidates to the American people in such a short span of time for them to actually make a difference, to contribute to the ticket as you describe?
I think it makes a difference in the states where it will matter. So this is not, that part isn't abnormal. I mean, picking your running mate and who that is. Clearly, you're voting for the presidential candidate, but if you're looking at states like Pennsylvania or Arizona, they're going to know who these people are. So yes, it's an uphill climb to educate the American public on who the vice presidential candidate is, but I think that that's the campaign's job over the next couple of weeks.
So we've heard a lot about a sugar high and a honeymoon and all of that, and I suppose you could qualify this entire period of time we're in straight through the convention, straight through Chicago. Then we get out on the road. The real sprint begins. Give us a sense of what kind of planning this campaign is going to be focused on coming out of August into September. Kids go back to school, people back from vacation, they're paying attention now.
I think you'll see a lot of focus, like you will just starting next week, on the blue wall states, quote unquote blue wall states. That's the easiest path to victory for the Democrats if you're looking at Pennsylvania and Michigan, Wisconsin, those type states. But I think you're also going to see a focus on North Carolina, Georgia, Arizona, those type of states where you've got strong down ballot candidates as well, strong governors who are going to be, I mean, you see the surrogates and how strong these surrogates are. So anybody who's in the race and the running to be the VP pick and is going to be a strong surrogate for her in those states. So I think you'll see a lot of focus on where the campaign needs to be focused in order to get to that number in order to win the presidency.
Well, and of course that could be physical visits like what we're going to see next week. It also could be just buying up time on the airwaves. She's going to have a lot of resources to do that. The campaign says it raised $310 million in July. What is the responsible way to spend that money, knowing that kind of fundraising burst isn't necessarily sustainable?
Right. So I think a number of things. You have to be up on air. You have to be up on television. So that's a given. And then you've seen the incredible success of the online forums, that she's had with surrogates.
Right.
You've said like
Zoom calls.
Like, yes, the white men for Kamala, the women for Kamala.
Yeah, they broke Zoom.
Right. But I think equally, if not more important, is the infrastructure that's already on the ground, the unprecedented infrastructure on the ground. I mean, the number of the folks that are walking around, the volunteers, the campaign staff in these battleground states, that's a responsible way to spend money.
Is it right to stash Joe Biden on a Monday night? He couldn't introduce Kamala Harris on Thursday?
I mean,
Am I looking at it the wrong way? You're going to say, hey, he's in prime time. That's a great slot, right?
That's exactly what I'm going to say. Prime time, great slot.
Gotcha. Kristen Hahn, it's always great to have Kristen with us. Partner at Rock Solutions and a frequent panelist here on Balance of Power. Of course, we like to tap her expertise whenever we have the opportunity. With so many questions, Kaylee, on this Democratic ticket, the next couple of days are going to be awfully important.
Indeed, in the next couple of months leading up to the election, especially as we consider what the Fed may do between now and then after what was a soft jobs report today, you certainly are seeing a robust reaction, shall we say, in the equity markets. The S&P on track for its worst jobs day reaction in 2 years. The NASDAQ 100 down 2.9% as we speak. Of course, in part, that's due to tech earnings with Intel down by 27%. on the day. That's a real number. And of course, you're seeing that filtering through the bond market as well as we reprice Fed expectations. Down 16 basis points on the 10-year to 381, down 24 basis points at the front end. The 2-year yield right now at 3.9%.
Yeah, it's not getting a lot better here. We could close near our lows of the day. And of course, Charlie Pellet will keep you posted on that as we make our way through Bloomberg Business Week, which incidentally is next. Kaylee, I'll meet you at 5 o'clock on the late edition of Balance of Power.
Sounds good. We'll see you then on Bloomberg TV and radio.
Connection lost.
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody, live on radio, TV, YouTube, and Bloomberg Originals. This is Bloomberg Business Week on this Friday, August Second, it is definitely a Jobs Friday, and I feel like we have one main story, maybe two, because it is about this morning's jobs report, but it's also what we continue to see when it comes to the Treasury trade in the United States and really Fed expectations, Tim.
Not just the Treasury trade, but also, of course, what's going on in the equity market. Bad news now, bad news for stocks. The S&P 500 on track for its worst jobs day in 2 years. The NASDAQ 100 down 11% from the July high at its lows today.
Correction, anyone?
Yeah, correction. That's where we are. Meantime, the bond rally continues. As you mentioned, Carol, it's all about those morning's monthly jobs report showed that U.S. hiring slowed markedly. The big question, is it an abrupt downshift in the U.S. economy?
Which is why we are talking about the U.S. labor report. We're going to talk about the trend line, the SOM rule, and yes, the continuation of the reset in U.S. rates and expectations for Fed moves. Also on jobs, Alan Guarino. He's vice chairman over at Korn Ferry on the jobs that are actually in demand right now. So we'll get some insight from him.
Plus, have you seen shares of Intel today? They are just cratering. It's on the outs, dropping the most ever on a grim forecast and big job cuts. We give you the latest from Intel.
It's a big Friday, folks. Let's get you going with a check on the overall trade. For that, we turn things over to Charlie Pellet.
All right, I thank you very much. Going to be very interesting to see how things close. We are very close to the worst level of the day right now. The Dow, the S&P, NASDAQ 100 index, Russell 2000, deeply in the red, right to the numbers now. S&P 500 index down 131, 53.15 on the S&P 500 index, where we stand right now, a drop of 2.4%. The Dow down 911 points, down 2.3%, and NASDAQ right now down 492 points, a decline of just about 2.9%. Russell 2000 index down 3.9%, 10-year at 3.81%, the 2-year 3.90%. Gold is down $18 the ounce, down 0.8%, and West Texas Intermediate crude down 4.3%, 73.04 a barrel on crude. Intel shares plunging after earnings. We got Intel now lower by 26.9%. Also keeping an eye on shares of Amazon after earnings. Amazon down 10.3%. Jeff Bezos' wealth slumping by more than $21 billion and moving higher after earnings. Apple, we've got Apple shares holding on to a gain today on a down day for the rest of the market. Apple right now up by 2.6%. So again, recapping here, steep losses for stocks, S&P down 2.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, as you know, the jobs report this morning, we got it at 8:30 a.m. Wall Street time. U.S. hiring slowed markedly in the month of July. The unemployment rate rising to the highest level in nearly 3 years. It does suggest a faster deterioration in the U.S. labor market than previously thought and puts the Fed solidly on a path to cutting rates in September. Now, the rise in the jobless rate triggering a famous recession indicator. It's known as the SOM rule, which has a perfect track record over the past half century. The mastermind behind the gauge, former Fed economist Claudia Sahm, who said on Bloomberg Radio with Surveillance's Tom Keene right after the report that while the U.S. isn't in a recession, we're not headed in a good direction.
Claudia Sahm, I've got to ask the media question. Is the SOM rule in force at this moment?
It triggered. Yeah.
Wow.
Yeah, so that puts it up over its 0.5 percentage point threshold, noting that comes off of historical experience. That doesn't necessarily tell us where, we are right at this moment, saying a recession. This has seen way too much momentum in the unemployment rate in recent months. 4.3%. Right? This is not, so whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market.
All right, that's Claudia Sahm with Bloomberg's Tom Keene. Earlier on Bloomberg Surveillance, I believe Damian Sassower also there. Meantime, the report further escalated. The bond market rally drove futures traders to price in expectations that the central bank will cut its benchmark rate by a full percentage point by the end of the year. There are other folks on Wall Street talking about several cuts, bigger cuts. So let's get to it and our deep dive on the jobs report and the move in U.S. Treasuries. With us, Bloomberg News international economics and policy correspondent Michael McKee right here in studio. Ira Jersey, Bloomberg Intelligence chief U.S. rate strategist. out there in BI headquarters in Princeton, New Jersey, and Anna Wong, Bloomberg Economics Chief U.S. Economist in Washington, D.C. Mike, I want to start with you. Lay it out for us how this morning's report compares to the data that we've been getting on the labor market. And I'm curious, as an economist, how you factor in the Somm rule.
Well, let's start with the data. It's basically a continuation of what we've been seeing, a slowing economy and a slowing labor market, except that it went much farther, much faster in 1 month than perhaps the Fed was anticipating. If you ratchet it down to 114,000 over the last couple of months, Fed would have been perfectly happy with that. It's kind of a neutral level. 4.3% is still a low, historically low unemployment rate. And we also saw average hourly earnings ease up a little bit, taking some of the inflation pressure out of the numbers. So under other circumstances, the Fed might have said this is okay. And obviously, we talked to Austin Goolsbee, the Chicago Fed president, earlier, who said we're not going to panic over one number. We're going to take a look at what else is happening in the economy, and that's going to be the question from here: is what else is happening in the economy? What other numbers, and how do they show up during the month ahead?
Shoulda, woulda, coulda, Mike. I'm wondering if Jay Powell would have had access to these figures. The Federal Reserve Board had a time machine and knew what was coming in the July payrolls report starting on Tuesday. Would they have made a different decision at their meeting, do you think?
Possibly. It's hard to know. It's really one of those situations where you can't know the counterfactual. I did talk to a number of open market committee members since the meeting, and they all acknowledged that Friday was going to be a risk-on event for them, and the risk came true. Now, does it mean the economy is falling off a cliff or going into recession, or does it just mean that we hit an air pocket? That's the part that they're not going to know, and that's where the Fed is going to fall back, what the Fed's going to fall back on and say, we can't just cut rates 50 basis points or intermeeting based on this one data point. And the Somm rule, if you take it out to 3 decimal places, the unemployment rate, we didn't quite get there, but it's angels dancing on the head of a pin. If the market thinks you're there, you're there. The only question is, where are you? As Claudia was saying to Tom Keene this morning, we're not in a good place, but it doesn't necessarily mean we're in recession.
Jay Powell reminded us on the press conference a lot of data points before we get to September. Anna, come on in. I want to bring in Anna and Ira. Anna, you first. Is this a report a game changer in any way to you, and factor into your outlook on the U.S. economy, be it better or worse?
Yeah, so we have been forecasting that the unemployment rate should rise to 4.5% by the end of this year for a long time now. And I think this report just is just right on schedule according to our forecast. And the reason why we think it will be rising to that level, which is higher than most Wall Street forecasts, is that we have seen a cooling in the labor market that had been pretty meaningful since the middle of last year. So while the rise in unemployment rate in recent months may have caught the Fed, who had been actually forecasting for the unemployment rate to decline in the second half of this year, while they might be surprised, I think that if one believes that this cooling had actually begun in the middle of last year, then you would think, well, it's already been cooling for a year. In fact, it just has reached that nonlinear point where the Fed can't stop it anymore. So I think the Fed is behind the curve.
All right. Well, then let's get to you, Ira, and forgive us, Mike and Anna, because I feel like we're burying the lead a little bit. The rally in what we've been seeing in the U.S. Treasury trade, getting another boost today. Ira, today's trade, walk us through it. That 10-year, going to 3.78 or so?
Really bounced right off a very important technical level, right at that number, I would mind you, something that we highlighted about a month ago.
So what do we do? I mean, we talked with you yesterday. You anticipate that the 10-year could go even lower. So what is the trade telling us today? Is it just a continuation of your think or something more?
Well, I'm thinking about taking vacation the rest of the year. We put out this morning a 382 forecast on the 10-year, so we're right there. So I'm done. I think the market's probably got a little overvalued here. And if you look at some of the technical indicators, at least in the short term, we'll probably get momentum in this kind of trade won't continue at this pace going forward. But I think the important thing is, like you noted, the 2-year note, rallying 25 basis points. It's been pretty volatile the last couple of hours as everyone's taken off the desks to go to the beach this weekend. And you look at the steepening of the yield curve, and that's completely expected in a situation where the Federal Reserve is going to cut interest rates, maybe not more than they anticipated, than the market had been anticipating, but certainly faster. And I think that's where we're going. Now you have banks coming out and even the market pricing for a high probability of a 50 basis point cut in September. I'd be curious to hear Anna's view on that, because Anna and I talked yesterday on a podcast, and things have changed now since then. So I'm curious if we hear that. But that's why you have this big rally in the front end. I do think that we'll continue to see bull steepening of the yield curve. 2-year notes will be down, under 4% in a hurry. I mean, they're very close to that. And I think that we keep going down to 3.5 on 2-year note. 10 years probably lag that, and that's where you get that steepening.
All right, so Anna, give us 30 seconds in response to what we just got from Ira, because we have Claudia Sahm here too, and we want to bring her in.
Yeah, so I think that Powell said very clearly that 50 bips is not on the table. But however, given today's data, I think they will indeed talk about it. It's still not the baseline as the market has priced in.
All right, Claudia, come on in. Claudia Sahm is with us. She's had a busy day. I'm sure a lot of people reaching out. Chief economist at New Century Advisors, founder of Sahm Consulting. We played a little snippet of your interview on surveillance with Tom Keene this morning, where he said, is this some rule in force at this moment? And you said it triggered. Yeah. Tell us your reaction to the jobs data and what it tells us right now.
This was a disappointing report. It may not be as bad as it looks, or maybe as the reaction is to it, but we have continued to see some slowing, now weakening in the labor market. We're still in a good place. It's just the direction we are pointed in. The direction of travel has been not in a good, we're not pointed in the right direction. So as I said with Tom Keene this morning, my read of the economy, looking broadly way beyond just the Sahm rule, is that the U.S. economy is not in a recession right now. We still see an expansion of economic activity, jobs created, some special factors going on right now relative to prior recession periods. And yet, the risk that we are pointed towards a recession, or we're in that kind of pre-recessionary weakening, those are really going up. And that's what we should, policymakers like the Fed should be stepping in and really thinking hard about. How can they short circuit those dynamics, which in the past do not end up in a good place?
Claudia, this is Mike. I got 2 quick questions. One on the Sahm rule, just so we can sort this out. Do you use 2 decimal places or 3 in doing the math?
Never in a million years did I dream others would be creating and writing. This was a very specific tool in a proposal to do stimulus if there's a recession. No, I look at the published unemployment rate, so just as it is, the 4.3%, and take a 3-month average of that. I want to smooth out bumps and wiggles, but I don't get fancy and, like do the calculation, 3 decimal places, all that. I take the 3-month moving average and then take that series and look in the prior 12 months, so not including the current month, the prior 12 months, and find the low point, compare it if it's a 0.5 percentage point or more. In the past, in U.S. history, that has occurred early in recessions. This isn't a forecast. On average, it's about 3 months into a recession is when the Sahm rule triggers. There's nothing magical about the formula or the cutoff. It was me looking at the historical record saying, when could we say with a very high degree of certainty, not perfect, but a high degree of certainty, that, hey, we're in the early stages of recession. It's time to get, say, fiscal relief out. That's, it was all with that purpose and not thinking about, today per se. And it's not a way to call a recession.
Ira, you want to...
Oh, go ahead. Sorry.
Come
on in, Ira.
Yeah, so I have a question. So you said about a fiscal response to a weakening economy. Given that deficits are still going to be running close to $2 trillion, how concerned are you that there might not be a fiscal response going forward if the economy does get meaningfully weaker? Obviously, the Federal Reserve can ease monetary policy, but fiscal policy might be more difficult to get in the next downturn.
Right. So in the context of where the Somm rule and the proposal came from, it was from early 2019. So I have certainly learned a lot as a policy advisor through the COVID pandemic. And the big thing the Somm rule falls down on is the taking into account changes in supply. And in its case, specifically labor supply, the labor force. And to your question about a fiscal response right now, because we are still in the last stages of fighting inflation, I would not endorse my 2019 proposal of broadly sending out stimulus checks. Even if I thought right now we were in that recession, it'd be more targeted, it'd be really, thinking about the inflation environment as well. So there is a cautionary aspect of thinking about the policy, but it does put the conversation out there. And to your point about fiscal space, though, if we were to get to a recession, if we were to get to a serious place, we have the fiscal space to respond. Whether we have the political will and kind of get it all together to respond, that might be a different question. And yet, really, the whole thing about this proposal, the stabilizers, is to let's have conversations outside of time of crisis about how to do fiscal policy as well as possible, knowing that we'll need it.
Anna Wong, I want to bring you back in here and talk a little bit about what Claudia said regarding labor supply, because I'm curious about, based on the numbers that we got this morning, how your view on the job market's ability to absorb more labor has changed in just a few months.
Yeah, one of Claudia's view is that, we're not sure whether this time what happened to the unemployment rate after the Somm rules trigger will happen again, which is that it should continuously rise for another 1.9 to 2 percentage point. So Claudia, this is as much as a question to Claudia herself. We have been looking at immigration and the absorption rate of these immigrants into the labor market, and we did note from the micro data from CPS that the unemployment rate for new immigrants are rising very fast. They're currently at 11%. And so I guess I'm wondering if the economy does lose this ability to quickly absorb these immigrants, would you still think that the Somm rule would be consistent with the historical pattern where it would continuously rise for another 1.9 to 2%?
So the labor supply, both the immigration that we have now that's pushing up the labor supply and at least temporarily or at this time pushing up the unemployment rate, that is causing the unemployment rate to be higher. I think the labor shortages previously had pushed down the unemployment rate notably, right, not sustainably. So, the Somm rule again is all about these changes. So I think there's my take of where it's at with the increased unemployment rate is it's probably overstating the recessionary dynamics. So we've got these supply dynamics that are it's a whole other topic. And yet under the hood, there still is a weakening in the labor force, a weakening for demand for workers, right? And to your point, that's the piece that if it gets momentum and it keeps going, that's the recessionary dynamic. Is absolutely, if it's really just a matter of we had a bunch of workers come in, the immigrants come in a big group and it takes time to absorb them. As long as you have a strong labor market, they do get they get jobs, unemployment rate trends back down, but that does require the labor market to be in a good place. So I think that's the question we don't know yet. Has that, how bad is that negative momentum? And that's why I said today's report was not encouraging. That it's not, I don't think you see a lot of improvement.
Let me put a question to Ira and Claudia, if you want to jump in on it as well. As I was saying at the top of the show, if we had ratcheted down to 114,000 jobs and slowly gone up to 4.3%, the Fed probably would be happy. So is it, what's causing the market panic, Ira? The fact that we move so quickly, or the levels that we're at? Because it doesn't seem the levels that we're at are, as we've been saying, recessionary or terrible.
Yeah, if it was 2016 and we had 114,000 jobs, you'd be like, okay, yeah, that's fine. But I do think it is the momentum and pace, and also this repricing of the risk, right? Because there are a lot of market participants who are worried that inflation might reaccelerate. We might have protectionist policies in the from the White House, and if things like that occur and we wind up with higher inflation, that maybe the Fed won't be able to cut as much. And I think basically that upward tail risk on inflation is coming off because of some of the data you have. Because remember, we're focused on this 114. The household data was actually a little bit better today than it had been, say, on a 6-month basis. But we had the labor force participation went up. We also had wages were disappointed to the downside too. And I think that those wage numbers, when you look at aggregate income, that is slowing pretty significantly. And I think that there's a lot of people who are looking at those type of data. You look at the market move today, you look at not only is our rates rallying and real rates rallying a little bit on the idea that the Fed's going to cut, but you also have break even. So inflation expectations have come down. You look at inflation expectations haven't been at 2% for 5-year inflation break evens in forever, it seems, right? Now, it wasn't forever, but it's been years since we've been at these kind of levels. And so I think that that's pretty telling too, just the market saying, okay, inflationary risk probably off the table for now.
Claudia, I mean, if you look at the market reaction and you look at the inflation expectations, et cetera, is there any reason for Wall Street to be calling for 2 50 basis point cuts in a row or an intermediate cut?
So the market reaction today, this is a big reaction. So my read of where the economy is, how to interpret, the guts of this report, like I don't see it as that negative. I have a hard time with the break evens, the inflation expectations. Like those are really big moves for again, it was a disappointing release. There have been a string. I think it absolutely is the direction. It's the momentum, right? Like what stops this train, right? And it could still be in a good place if we stop kind of close to here. But that's just, I mean, this has been a very difficult cycle. There's been a lot of uncertainty. I mean, this comes not 2 days after we have Jay Powell and the Fed tell us we don't want to see any more weakening in the labor market.
Yeah.
We're not seeing it. And then we get it. I think it's just been a lot to process. So I don't think this is I think this is one day. This has been a really wild ride. I'm not updating my expectations on what the Fed does off of just today. And I think we can all just take a deep breath.
We are running out of time, but I do want to get final thoughts from